morning. So we'll start with section A continuation of our revision of the part 2. Okay. So in this, yesterday we completed till sustainability growth rate, and we covered all of this ratios, all of the initial thing like comparative financial statement, what is income statement, measurement of income statement. Now we'll start with the topic of special issues. What is this special issues and what are the topics? We'll have a like very minimal, very theoretical topic, very small topic we have, which needs to be covered. As I told you yesterday, like these topics the students ignore, but please don't ignore these topics too, because these topics also important. Okay. So in the special issues, the first topic is foreign currency transaction. What is this foreign currency transaction is? Usually a company, an organization will do a transaction in foreign currency. Example, suppose if I'm doing a business in India, either way I'll import something from foreign, or I'll sell goods to the foreign countries, right? So either this buying and selling might happen. This is one scenario. And the other scenario is I might be having a subsidiary. Subsidiary means what? I might be having like my another branch or my subsidiary company where in the foreign country. These also might happen. These are the two cases. So one case is what? One case where I'm just doing the transaction. The other case is what? I have a operation. I have a running business in the foreign, but the parent is who? Parent is B. So we have a subsidiary in foreign countries. So understood these two cases. Now we'll first go through the first case, which is a transaction case. Then we'll go to the subsidiary in the sense like parent and subsidiary cases. Okay. So the first case in the foreign currency transaction is when we have a payable or receivable. When we'll have a payable or receivable means like when we do a sales or purchases. Correct. When we do a sales or purchases only, there will be a foreign currency transaction, right? So when we do a sales or purchases, what will happen? Here we might create receivables and payables. We might create what? Receivables and payables. So this creation, the receivables and payable creation, would happen in a different date. See, I will be buying or selling at a different date, and the customers or to the suppliers I'll be paying on a different dates. Correct? It is not on the same date, right? Example, July 1st I purchased the goods from my supplier, but I'm paying him in the month of August. Now tell me, on the both date the foreign currency exchange rate will be same or different? Will it be same or different? It will be different. But now the question is, what need to be recorded and how need to be recorded? That is a question. So when the transaction occurred, in this case, what will happen? First of all, whenever there is a foreign currency transaction, the day you do a buying or selling, right? On that day, what is the exchange rate that you have to write? Example, see the transaction, when recording the transaction, as example, October 1st, you sold some goods on credits. See, if it is in cash, today only it will go, today only it will come. That's not a problem. Now, normally what is the journal entry for sales, credit sales? Account receivable asset increase to revenue, income increase. So on this day, whatever the exchange rate is there, based on that you have to write. So that is the reason here I have given current spot rate. Current rate you have to write. Now done. Now this guy have not settled till 31st December. Guys, there will be two cases, settling before 31st and not settling before 31st. First we'll see not settling before 31st. Now on 31st of December, what is a special? We are going to close our books. When we close our books, see, important, first transaction date, spot date written, done. Whenever we close our books, on the date, if still this guy have not done the payment, it applicable for both payable and receivable. applicable for both. Okay, if you have not done the payment or your customer have not done the payment, you have to again rewrite this. Rewrite in the sense you have to go and adjust this based on the exchange rate. If it is increasing, it is a gain. If it is decreasing, it is a loss. Something like that. We'll see. We have an example. We'll understand that. But understand the outline. The day which you do the transaction, chalo, spot rate. 31st December done. Still there is a payables and receivables outstanding. Convert that into that date. That date's exchange rate. On 31st December, what is the exchange rate? Convert that into that rate. Either it will be gain, either it will be loss. But on that rate, what you have to do? If it is a gain, yes. If it is a gain, what will increase? Asset will increase. Gain means asset will increase. Asset increase means debit. So account receivable will be debited. And we know incomes and gains where you will report in the credit. But if it is a loss, loss is an expense, loss should be debited. From where you are losing, your account receivables are losing. But no cash is impacted till today. Account receivable will be go down. This is when on the balance sheet date. Chalo, abhi this guy have done the payment. Okay. Now when he done the payment, what is the first thing you will get? See, whenever any journal entry related to payment, majorly in part 2 will be not having that much journal entry. But I always use this shortcut whenever there is a journal entry which is related to cash. It is easy to put the debit or credit of the cash. Whenever this guy have paid the cash, what I will get? I will get the cash. Cash I will be receiving. So cash debit. What I am going? Account receivable credit. Based on the final valuation it is done. Suppose if this guy have settled before 31st of December, right? The 31st of December adjustment is not required. Direct cash. Spot rate, cash date. That's it. Okay, now we'll go through the example. In the example, you will understand this foreign currency transaction. Okay. See, US company making a sale to UK company. We are US company, we are making a sale to UK. So this is sales. Sales means what will happen? Receivables. So it is not necessary every time it should be receivable. Sometimes it will be payable. So it will work opposite. Okay. And the sale is denominated in British pounds. So the British pound is 10,000 pounds. You have done the sale for how much? 10,000 pounds. But where you are? You are in the US. So on the day you did the sales, right? On the day, this is the exchange rate. 10,000 pound is equal to 1.54 US dollar. Then how much US dollar you will be having? On the date, you will be having 15,400 US dollars. Based on the spot rate, you have to write 15,400 US dollars. So what is the double entry you will write now? Account receivable, account debtor to sales account how much? $15,400. Now the financial date came. You are closing the books. On the date, current exchange rate on the statement date. I mean the date whenever you close the books, that day you go and check what is the exchange rate. On that day the exchange rate was 1.56, it seems. What happened now? So 10,000 pounds we written as 15,400. Now we should write as 15,600. What is it? Gain or loss it is? It is gain. Because 15,400 now it became 15,600. You should, if it is giving side, right, then it is a loss. Now it is getting side. Getting side means you will get $200 extra. Chalo, 200 is a gain. Don't go and write again 15,600. What is gain? That much you reported. So this is 200 in gain you will write. Under which gain you will write? Unrealized gain. Not realized. Still you haven't received. Unrealized. Okay. Now the payment date came. And you know the journal entry of unrealized gain. We just saw, right? Account receivable to unrealized gain will write 200. On the payment date, what happened? Oh, again, there is a twist with the... now the 1 pound is equal to 15,200. But you just told it will be 15,600, right? Now you are telling it's 15,200. So now what happened with the $400? 400 from 15,600 it fell down to 15,200. So now what will happen? You lost $400. So $200 you lost from the unrealized gain. Unrealized gain you recorded, right? That from that you lost $200, and your real money was involved. How much? Your money was involved. Initial sales spot rate, how much you have recorded? 15,400. From that you minus 200. So totally 200 minus 15,600 minus 400, 15,200 is the amount you are receiving. So what will be the double entry now? Cash to account receivable. So understand 3 days. 1, the date of record, it will be on the spot rate. Next, financial statement date. 3rd, payment date. This is with the foreign currency transaction. Now we have a foreign accounting for foreign operation means we have a foreign subsidiary. There we don't have any subsidiary, we are just doing transaction. But here we are having what? We are having foreign subsidiary. When we have a foreign subsidiary, what will happen? We are the parent company. Subsidiary is in another country. That company is also belongs to me, right? So whenever I present my financial statement, I have to consolidate their income statement and balance sheet also, because that is also my company. But the problem with this, now US is doing a business in India. Whenever they do a business in India, they will record in what? Indian currency. But in US, they have to report in Indian currency or US dollar. So they will report in US dollar. Now the point is, you recorded your financial statements in one currency and you are presenting in different currency. So then what we have to do? We have to convert it. That is what this discussion is going on. Okay. Now, first of all, when a company is following your subsidiary, before you convert all these numbers, right? If the company is following different from the GAAP, you have to first, what you have to do? You have to convert into GAAP. First step. Before you do all these conversion activities, right? With the playing with the dollars. Before you play with the dollars, if it is if the subsidiary have followed non-GAAP, example, US is having a subsidiary in Germany and Germany have followed non-GAAP standard. Might be IFRS, might be their own accounting standard. First step, what you have to do? You have to convert those books into US. First, US, according to US GAAP, you have to do. Then go and do all this conversion activities. Okay. Then what you have to do? You will convert into US dollars. Okay. Clear with this? Okay. Now, before we learn about this conversion, we need to understand about 3 currencies. So these 3 currencies are very important to understand this. So I'll explain you what are these 3 currencies. 1, currency of record. 2, functional currency. 3, reporting currency. So the foreign subsidiary, using the journal entries, ledgers, financial statement, they are writing in some currency, right? That is recording currency. They might write in their own currency, they might write in some other currency. Whatever it is, that is called as recording currency. The foreign books, foreign subsidiary they have written in the books is called as recording currency. Next, this is a little bit confusing, like confusing in the sense which need to be given more important, is called as functional currency. This is a currency where the primary economic activities take place. What is this primary economic activity means? Where cash flow, sales, expenses, okay, this and all is happening in this currency. That is called as functional currency. It's a currency which the entity earns and spends its cash. Which one? Functional currency. Third one, reporting currency, which is nothing but US dollar. For the US parent company, what is the reporting currency? US dollar. Chalo, now we'll understand with this example. So now you understand there is three currency: recording, functional, and reporting. So US parent company is having a headquarter in New York. New York means it is in US. We have headquarter in New York, but its subsidiary is in where? Switzerland, some other country. Switzerland is one of the European countries, so it is in Switzerland. Now they are recording in Swiss franc, where the subsidiary is recording in Swiss franc. So that is called as what? That is called as currency of recording currency. Chalo, Switzerland company, they are whatever the sales, expense and all is happening, just recording in what currency? Swiss franc. So that is the recording currency. Now, even though the office is in Switzerland, they are recording everything in Switzerland. The subsidiary 90% of business is coming from the Germany and France. Oh, the business, the cash in, cash out, the sales, everything is coming from where? From the Germany, but just the office is in Switzerland. Accounting record is in the Switzerland. Everything they are doing a transaction in, cross-border transaction is happening. So in Germany and France, they will use what? Euros. So they receive payment in euros. They are paying to the suppliers in the euros. So euros is what? Functional currency. Okay, understood. Their office is just in the Switzerland, but they are doing their major transactions and all is happening where? In the euros. See, sometimes both will be same. Sometimes they are in the Switzerland, they will do major transaction in Switzerland. Then what need to be done, I'll tell you. But this is when the transaction is happening in major currency. See, anything, suppose if their transaction is happening in US dollar, US dollar will be functional currency. So then the reporting currency and functional currency is same. Now the reporting currency for a US company is what? US dollar. So this is a parent company country's currency. This is easy. Okay, clear with this? Now we need to understand two terms in the conversion process. Is called as remeasurement and translation. What is this remeasurement? What is this translation is? Now they recorded in one currency, but they are doing the transaction in different currency. They have to report in different currency. Remeasurements from the currency of record. You recorded in your recording currency, which is Swiss franc, but you are doing the transaction in euros. So from the recording currency to you have to convert to functional currency. So this is called as remeasurement. How it is done, we'll learn it. Translation means you have recorded in functional currency, right? Now from the functional currency to reporting currency, you will report it, right? You will convert it, because at last you have to convert to reporting currency. So that is known as translation. Recording to functional, remeasurement. Functional to reporting is translation. Suppose if your recording currency and functional currency is different, you have to do both. You don't only have to do remeasurement and translation need to be done. But if your functional currency and reporting currency is same, what currency? Functional currency and reporting currency is same, just remeasurement is enough. Translation is not required. Why? Remeasurement is what? From recording to functional. Your functional is already US dollars. So why once again you have to do? So from recording, if you're starting from the recording, it is remeasurement. From recording to functional, remeasurement. And the functional is also US dollar, right? So remeasurement is only enough. Next is what? Your recording and functional is okay. Your recording and functional is same, but reporting is different. See, in this case, your recording and functional is same. Remeasurement is not required. Translation you have to do. Example, the Swiss company is there, right? Their functional currency is also Swiss franc. So then what you have to do, from the Swiss to US dollar you will do, done. One is translation is enough. And only remeasurement is enough when the functional and US dollar report when the functional currency is US dollar, or the functional currency and reporting currency are same. So this table will help you to understand that. Okay. Now what is this remeasurement and translation, we'll understand. So in remeasurement, again, the first step is what? Convert non-GAAP into GAAP. If it is non-GAAP, convert into GAAP. So this we call it as a temporal method. In this temporal method or non-monetary method, you are converting the items, right? So convert all the monetary items. What items? Monetary items in the balance sheet and the current exchange rate. On the date, what is the exchange rate? On that exchange rate, you have to convert. What items? Monetary. Non-monetary item, historical exchange rate. From the date the original transaction you purchased, right? On that date, what was the exchange rate? That you have to convert, not today's date. Next, equity in the balance sheet. This is also same. Historical exchange rate. Okay. Income statement. Some items will be related to balance sheet, like inventory, cost of goods sold, and depreciation. Those are coming from where? From the balance sheet items. So those items is a non-monetary. So those items you have to convert using historical rate, and others you have to go through weighted average exchange rate. Based on the average exchange rate, you will convert it. Clear with this? This is a monetary and non-monetary we call. Monetary item, current exchange. Non-monetary, historical. Equity, historical. In the income statement, expenses related to non-monetary like depreciation and cost of goods sold. Non-monetary, right? So it's historical. And other revenue expenses, this is done through weighted average. Okay, clear with this? Okay. Now when we do remeasurement, right, there will be some gains and losses. See, even in a small one transaction, there is a gain and loss. Your entire income statement we are converting, so obviously there will be a gains and losses. So the gains and losses will be there in remeasurement. So that you need to, where you have to report, that you need to report in the income statement. Under this, income from continuing operation, yesterday we learned, right? So in the income from continuing operation, you have to report this. So how it done? We'll debit and do the credits, remeasurement gain, okay, and report it to income statement. Why we are telling exactly reported to income statement means because translation is done different way. Okay. Now translation is done through what method? The current rate method. We call this as current rate method. Here, all assets and liabilities, all balance sheet item other than owner's equity. I mean all balance sheet item, assets and liability, easy, current exchange rate. Just the name itself is there, right? Current rate method using the current exchange rate. And owner's equity amount other than retained earnings. Now in the balance sheet you take everything, you should convert using current exchange rate except equity. Equity you need to convert using historical exchange rate, but in the equity what will be there? Retained earnings. Retained earnings you stop, don't do with the historical exchange rate. Okay. Now the retained earnings will be cumulative translated amount. Cumulative translated amount means it is using the income statement only, the retained earning is affected. So all revenues and expenses may be translated using what? Weighted average exchange rate for the period, or the actual rate for each transaction if it is practicable. Each date you did a transaction, right? By using that, if you are able to convert it. Or using what rate? Weighted average exchange rate, like sales, rent, utilities and all. And in equity, common stock, additional paid in capital. In the assets and liability, all cash, inventory, fixed asset, payables, receivables, everything. Using what rate? Current exchange rate. Clear with this? Now there will be some gains and losses here also. As we had a gains and losses in remeasurement, right? Here also we'll have some gains and losses. So this gains and losses is not reported in income statement. This gains and losses is not reported in income statement. This is reported where? In the balance sheet, accumulated other comprehensive income. Clear? Okay, this is not reported where? In the income statement. In the remeasurement, you report in the income statement. Translation, directly in the balance sheet you come. Go to the equity side. They'll report as a separate line called AOCI, accumulated other comprehensive income. Okay, clear with this? Okay. This understanding. I just explained, right? Remeasurement, gains and losses from the continuing operation. You report in income statement. Translation is in accumulated other comprehensive income. So from recording to functional, there will be remeasurement. From functional to reporting, translation. Okay, clear. Okay, next we have something called as done. In the rest, everything is a small topic. With this topic is known as what? Impact on inflation on financial ratio and reliability on ratios. See, inflation, what does this inflation do? Inflation, first of all, it makes your comparison difficult, because the few asset you would have bought when very long back, but the depreciation you're charging is using the old rate only, not the current exchange rate. See, impact of inflation, I'll go with a story and I'll explain you with an example. Suppose I was running consider I was running a bakery. So I was using old system method. So I got my income statement and everything. I saw I have exponential profit. Okay, profit is there, good. But that profit is not even sufficient to pay the salaries. Why? Because old depreciation. Yearly, see, inflation is increasing. So all the expense will increase, but the depreciation will be not. It will be using the same amount only. The base is still the same, 1. Now, because of that, what happened? Your expense went down, your profit is showing more. One thing. Next, you are using the old inventory. Assume I was running a bakery and I was buying all the raw materials very long back. If I would have purchased the raw materials, everything 6 months before, I would have received for a very cheaper amount. And now if I do a sales for the current market price only, I will do the sales, right? Everyone in the market now selling puffs and samosas for 40 rupees and 50 rupees. I'll also sell that because of the inflation. But the floor, the raw material I used in this was older. So because of this, what happened? Profit will be more, because the cost of goods sold is less. That is good. And one more thing, interesting part is you have a benefit of taking a loan. Inflation is increasing. You took a loan. You pay the interest, still same. See, all other expense will keep on increasing, but interest will be same. So that is one extra benefit. And at last you pay the principal, right? You are paying cheaper, because see, you borrowed 1 lakh today. After 5 years, if you want to repay them, the 1 lakh today has more than value than 5 years. 5 years later, this 1 lakh is cheaper. So then I can easily pay. So that is one benefit by taking the loan. Okay. So now what happened? I saw the exponential profit, but now I want to pay the payroll. So the payrolls are very high now because of the inflation. I want to buy new oven. Now what happened? So I can't afford it because due to the inflation. So this is the impact of the finance. So what does it made? It made the comparison difficult, and also inflation will lose what? Lose the purchasing power. But inflation also gives what? A debt advantage. Whenever you pay back cheaper, and it overstate the income. Because of the depreciation, we're using the same depreciation, it overstate the income. And because of the inventory, we use the older one, which we bought cheaper, it is also overstating the income. So this is the effect of inflation. So impact of inflation is what? Inflation is like a tax on cash balances because it loses values. Inflation causes loss on monetary asset because the purchasing power of the asset declines. Inflation gains on monetary liabilities. That is what I told. If you take a loan, you will pay back cheaper. So it is gaining like something you're gaining. And the interest you pay is same. It is not increasing. Clear with this? Okay. So these are the effect of inflation which I already discussed. Next, the another bigger topic is changes in accounting and error correction. See, obviously there might be errors in your finance, not in the financial statement, or there might be some changes you will be making. So what all the changes, what and all we'll learn. So the types of changes are change in accounting principle. Either you change what? Principles, or estimate, or reporting entity. Accounting changes and error corrections are affecting financial ratios. Yes, whenever you make the changes, the financial ratio will change. Why? Because the financial ratio base is what? Your financial statement. If you're going and playing with the financial statement, your ratios will again change. Okay. So what are the three changes we learned? Change in accounting principle, change in reporting entity, and change in the estimates. Accounting estimates. A change in accounting principle occurs when you accepted a gap different from previously used. I'm not telling you're using a different standard and coming. You're using gap only. But now what happened? You were using a different gap standard. Now you want to change with a different gap standard. So change the method of applying the generally accepted principle. Changes to the generally accepted principle when the principle previous used is no longer generally accepted. Something you are changing the standard because of some changes or because of the amendments. What you did, you are changing the gap. But whenever you change the gap standard, what is happening here? You have to change retrospectively. You have to change retrospectively means you have to change all from the first date of the financial statement to till the date. Okay, so we'll understand there are three methods of accounting. One is retrospective, prospective, and restatement. Retrospective used for what? Accounting principle and change in reporting entity. When I told three changes are there, principle change and reporting entity change, what you have to use? Retrospective. And the estimation change, what you have to use? Prospective. And restatement is used for the errors. This is not change, this is because of the error. Okay. Now, retrospective application, if practicable, sometimes it is not practicable. Okay. Because they are telling, oh, go and change from the first year. 2015 you started company. You should go and change from the starting till year. Where from 2015 to till year, you have to change it. If practicable, then do. If it is not practicable, no problem. Going forward, you take care of. So retrospective application, when you have to use is whenever the change in the accounting principle, you have to go retrospectively. So retrospective application require carrying amount of asset, liability, and retained earnings from when? From the beginning of the first period reported. Okay. All periods must be individually adjusted. An example of direct effect is adjustment of an inventory balance. Like one example of principal changes from FIFO to LIFO you are going. FIFO does what? Last in, first out. FIFO does what? First in, first out in the inventory. Or this change, what will make this is a principal change. Both are accepted. In IFRS, I think LIFO is not accepted. But in US GAAP, both is accepted. So you are going from one principle to other principle. So you have to change retrospectively. And you have to explain why you are changing, what is the use of this. Okay. Next, a change in reporting entity. In reporting entity change also, what you have to do? Again, retrospective. What is this change in reporting entity means? Suppose you are running a company. You acquired a subsidiary. Assume that 10 million you did a revenue in 2024. In 2025, what you did? You went and acquired subsidiary, and in that year you are showing 50 million as a revenue. How from 10 million to 50 million you got? Because of not you acquired some subsidiary. Because of this, you have to again do retrospective. From the date you started, right? From the date you started your business, started to present your financial statement. From the date to till date, you have to merge both financial statement and present it. Why we are all doing this? Because to show our investors, to show our shareholders that see, this is not only for this year. Suppose if it could have happened from the day one, this is the case. So that investors can take the decision properly, which is where retrospective. Now we have third one, other changes, accounting estimate. Accounting estimate means, I'll tell you what it is. Estimation, right? Estimation means, suppose we are estimating the bad debts. Provision for bad debt will create, right? Allowance for bad debt here will create. So allowance for bad debt is created based on the estimation. That is an expense. We are estimating 2% will not give. Now you want to change it to 4%. So in that, the estimation changes, what you have to do? You have to go prospective. Prospective means what? Don't do anything in the past. Retrospective, go and do the past. Come back. Prospective means nothing should be done in the past. From today, going forward. From today, going forward, what you have to do? You have to apply this. Example, a method of depreciation, amortization, depletion of long-lived asset, non-financial asset. One example I can give is like bad debt, estimation of bad debt. And in part 1, you learn estimation of warranty expense. Warranty expense is already estimated and recorded as an expense. So that is also estimation. If you're changing the estimation, change. No problem. But going forward, apply that. Don't do anything in the past. Which is this? Accounting estimation. And there might be some errors also. What is this error? Sometimes you might do a mistake. Mistake means you do a mistake mathematically, like some numbers changed, or mistake in the gap application, used one standard to different standard. Some mistake you did in the application, you're using the standard, or oversight or misuse of fact when the statement are prepared. You did some fraud, you deliberately not added something. This and all is called as what? Error or mistakes. Whenever there is a mistake, what you have to do is you just need to go and rectify the mistake and come back. Okay, an accounting error related to prior period is reported as prior period adjustment. By restating prior period statement, restatement requires same adjustment retrospective application. Okay, see, you did a mistake in 2018, fine. From 2018 to till date you do, but it is not required that you have to go from first to you have to do. From where you did a mistake, that you go and change, and the affected one you can change it. Okay, this is an example. So here, John's, you were using what? FIFO. In 2014, whenever he started a business, right, he was using what? FIFO. In 2018, you want to change into LIFO, it seems. Management wanted to make these changes in 2019. But the CFO concluded it is impracticable. I told, if practicable, do. If it is impracticable, no problem. If it is impracticable, he is telling no, it is not practicable. So they have a financial statement information for 16, 17 and only 18 it seems. Because from 16 they have. But the company started when? 2014. From then he was using FIFO. Then you do one thing. From 2015 the ending balance. go on the FIFO basis, you start from LIFO from 2016. From whenever you can, from there you start making retrospectively changes. Okay, that's it. And this is a retained earning adjustments. See, anything making a changes, at last where it will come and effect, you know, it will come and effect in the retained earnings. Example, you did a mistake in where in 2018 you did a mistake, like assume that you understated the cost of goods sold. When understate cost of goods sold, your profit will be overstated. At last profit will be overstated. If profit is overstated, where it will come and sit? At last it will come and sit in the retained earnings. So better what you can do, there is a error, right? Go and do the correction where? In the retained earnings. Normal unadjusted retained earnings you take. Do the correction. This 3 is given because whatever you do, you can adjust in the retained earnings. But do the correction and bring the adjusted one. And now you do normal this year retained earnings. So how the retained earnings formula is? Beginning retained earnings plus profit minus dividend is equal to ending retained earnings. Because retained earnings at last, all the profit will at last sit in the retained earnings. See, there is a relationship between whom and whom? Balance sheet and income statement. Income statement, what it will give? Every year it gives a gift to the balance sheet. That is called as profit. It gives you to gift to the balance sheet. It is called as profit. And where it will give? It will give to the retained earnings. Okay. And the other topic. Change in depreciation method. It's a estimation. Book value and market value. Okay. So yeah, we did book value per share, market value. Yesterday we just discussed about this, right? So book value and market value. See, company book value will be different and the company's market value different, because book value is based on the gap and the record. See, if book value, what yesterday we did, asset minus liability, equity we took, equity divided by number of shareholders we did. Same, book value means take your company balance sheet, the equity portion is the book value, but this is based on historical. Market value means what it is. You go to market today, see what is the market price of the share, price of market share into common share outstanding, you will get what? Market capitalization. Book value and market value will get. Okay, book value means from the income statement you extract. Market value means go and see in the market what is the price of the stock multiplied by number of shareholders, you will get market cap. In the news you can hear this, Reliance have this much market cap, Tata have this much market cap. Okay, next, fair value means using gap rules. Gap rules, you create mix of this value. For example, investment or security reported at current market value, that is fair value, but buildings and equipments are reported at book value, historical cost, which ignores change in actual worth over time. So fair value means the price that would be received to sell an asset or liability in order to transaction between market participant and then current market condition is known as fair value. Understand market value, book value and fair value? Okay. Now we have accounting and economic profit. What is this accounting profit means? Take your balance income statement. What is the profit? That is accounting profit. So this is accounting profit. Economic profit means economists use this economic profit. So economic profit means we will minus what? We will minus opportunity cost or implicit cost. What is it? We'll learn. So accounting profit means revenue minus all explicit cost. Explicit cost means the cost which you report on the income statement. So these are the costs for which the company actually has to make a payment to another party, where the actual transactions is happening, which is explicit cost. But economic profit means take total revenue total revenue exceed the economic cost. Economic cost means there is both the cost. In this, explicit and implicit cost. So total economic cost include explicit, which we already told, and implicit, which is nothing but your opportunity cost. Economic profit will be economic profit never will be higher than accounting profit, because why? Accounting profit you are doing only one thing minus, but economic profit you are doing two things minus. Okay, so to explain this economic profit, I'll go with an example. Suppose you're doing a business, you made 5 lakh profit, all expenses are minus, everything is done, you made how much? 5 lakh profit. But to do a business, you sacrificed your job. If you would have went for a job, you could have earned 2 lakh. Now doing a business, how much you earn? 5 lakh. But if you could have tell me, like, if you could have, you have sacrificed the job to go to do the business. So the salary, right? The salary you lost. See, there you're not losing some money from the pocket. Something you should get, but you're not getting it. Why? Because you're doing the because you're doing the business. Okay. So that 2 lakh you have to minus from the accounting profit. That is called as economic profit. So implicit cost in economic profit. So interest lost on money that have been invested in business instead of elsewhere. Assume that you are starting a business, you have to invest money, right? But if you could have invested that in the stock market, or if you could have invested in the FD, you could have earned some return. That is economic profit, because by using this fund, either you have this option or that option. It is not that you have both options. Okay. The level of accounting profit that could be earned moving from the firm's productive resource to the next best alternative is known as implicit cost. Okay, clear? Now we will understand this with the example. Okay, now Sarah started a business. Sarah received 200,000 in her revenue. How much she is receiving? 2 lakh in her revenue, and the expense and all is coming around 1,80,000. Okay, she also pays 5,000 interest on a bank loan on each year. Okay, accountant depreciate the equipment Sarah owns 10,000 per year. There is depreciation is also happening, where she has some equipments and all, where the depreciation is happening. At the beginning of the year, equipment had a fair value of 2 lakh. Now it is having a fair value of 1,80,000. But what was the beginning value? 2. What is the fair value? 180. But what is the depreciation you did? 10,000. But 2 lakh minus 10,000, it should be 190. But why it is 180? Because in the market it depreciated. Assume that you have a bike. Okay. That you bought this bike for 2 lakh and you did depreciation of 10,000. Now what is the book value of the bike? 190. But in the market, the value of the bike is just 180. So you lost 10,000 in the market. Okay. And amount that are invested in capital could have been invested in security and earned 5%. Now what they are telling, suppose if Sarah have not started a business, if she would have invested that money somewhere else in the securities, she could have earned how much? 5%. And her salary at Sarah has received an offer from near factory work where she could have earned 30,000. Now Sarah, if she could have went to a job, she could have earned how much? $30,000. But now as she's doing a business, she can't do that. So what and all she sacrificed? 5%, 30,000 salary. Okay. Now Sarah's next best alternative would be opening a company in another industry where she can earn 40,000 salary and accounting profit of an additional 20,000. If Sarah could have started some other business, she could have earned 40,000 in salary, and she could also earned what? Additional 20,000. To calculate the economic profit, what you will do? First we'll calculate the accounting profit. See, now she made a revenue paid all the expenses. So what is the profit she made? 75,000. This is what revenue minus explicit cost. And these are implicit costs now. Sarah lost wages. She could have, the next best alternative was what? See, next best alternative was not going to a job. Next best alternative you have to take. You should not take both the alternatives. That is a mistake we do. We'll minus the, if she could have done job done in different factory, and we would have minus what? 5%. No, like we would have minus that other business she could have earned 40,000. So which is better? 40 is better or 30 is better? 40. So we have to take as an alternative what? 40,000. So that you minus. See, nowhere I minus 30. That was also alternative. But we have to take what alternative? Next best alternative. Okay. Because she can't do both the things. Either you do this alternative or this alternative. I mean, she was having option A and option B. Option B was better than A. So the next best alternative was what? B. That is what we took. And Sarah's lost interest. Suppose she could have invested, Sarah's lost interest, second one. Like she could have invested somewhere and she could have earned what? 5%. That one. And economic depreciation. This is what we told. What is this economic depreciation? The economic depreciation is a decrease in the fair value of the asset. 2 lakhs asset now what is worth now? Only 1,80,000. And last, accounting profit. Suppose she had another option of doing business, right? If she could have done that business, she could have earned how much? 2 lakh extra. Now 75,000 is what? Accounting profit after minusing all this cost. She's 75,000 it was? 75,000. Then we'll minus everything. How much it is coming? 2 lakh minus 1,15,000 and minus 150, 90. 1,15,000 minus 90. Sorry, not 1,15,000 minus 90. 2 lakh minus 1,15,000 minus 90,000. Minus 5,000. She is losing how much? Minus 5,000. So better than doing this job, running this company, she needs to start the different company because she can earn more 5,000 there. That is what called as economic profit. Okay, one more example if you want to give like a trickier example. Not all alternative, only next best alternative. Best alternative is like 5% also you wrote. See, because here, what and all? The accounting profit. Suppose if she could have done the in another industry, earn a salary of 40 and accounting profit of how much? 20. And here, the amount that were invested in capital, if she would have invested where in some other security, she could have earned how much? 5%. Now this is a conflict. Now the example says what? Any amount that is capital have been invested earning how much? 5% return. The amount that is invested in capital is the fair value of the equipment at the beginning of the year. What is the fair value of the equipment? She was using 2 lakh because that is the invested capital, right? Suppose she could have not, if she would have not invested in that, which was 200,000. If Shara had lost the capital equipment for 2 lakh at the beginning of the year and invested 5%, means how much she could have earned? 10,000. Okay, so the lost interest is the interest that Sarah could have earned if she had invested in the security. So because of doing this some dog sweater for dog business, right? She bought what? $200,000 of some equipment. Suppose she could have invested that somewhere else. She could have earned how much? 10,000. She could have earned 10,000. But now she have not earned. Why? Because now she is doing that business. So that is called as like Because of that only we are considering that. And that is a different business. The next best alternative will be opening a different company, and it is different industry. And there we are never talking about how much capital is going to invest on that. Okay. So only we took both the options. Okay. Now one more example I can give that. Suppose you were doing a job and you were earning salary of $40,000. Okay. Per annum you were doing a $40,000. Now you are going for an MBA program, and where you have to spend $20,000. Okay. What is the explicit cost in this? Explicit cost is only 20. But what is implicit cost? 20 plus 40. Implicit means implicit plus explicit cost will be 60,000 is the cost of doing the MBA. Why I'm telling the cost of doing MBA is $60,000? You are paying only 20, but you sacrifice the job, right? The best alternative for the MBA was what? Job. You sacrifice the job. Through the job, how much you could have earned? 40,000. That 40,000 is an opportunity cost, because that opportunity you left and started doing a MBA. So the MBA implicit and explicit cost come around how much? $60,000. Clear with this? The same example with the Sarah applied. Sarah could have started some other business where she could have earned more, where she could have earned 40,000 salary, but she sacrificed that, and doing the current business, she is losing how much? $5,000. It doesn't mean Sarah is losing 5,000. She is earning 75,000 accounting profit. But if she could have done other, she could have earned more. Here he is not losing 60,000 from the pocket. He is losing only 20. But the 40 he should have got, that he is not getting. That is implicit plus explicit cost. Clear? Okay. Now the last topic is earnings quality. What does this earnings quality means? So we discussed this, right? Where the managers will manage the income is known as earnings management, which is like bad. So earnings quality will be high and low when we'll see. See, quality of earnings means it doesn't mean profit and all. Don't assume profit is equal to high quality. That is quantity wise is you're doing better. Quality wise, from where this profit is coming, from the where the revenues are coming is known as earnings quality. So earning quality measures how sustainable a company profit are, from where the profit is coming. It looks at the source of the money, not just the final number. See, this one line is enough. So earnings quality doesn't worry about what is the profit, what is the revenue you are making. It says from whatever you are making, from where it is coming. So if the profit is coming from selling the products and cutting the cost efficiently, high quality. But if the profit is coming due to the inflation or due to one-time events or accounting tricks you use, that has a low quality. See, due to inflation also you will earn some profit. Okay, that and all is a profit only. We are not denying that, but doesn't have high quality of earning. Okay, so earning quality determines this three factors. One is the business environment, what they do, and what is the accounting principle and the character of the management. So business environment means, suppose your company is more dependent on one type of customer, only one customer. Example, some companies are more dependent on government. The company like a defense contract and all is there, right? Those companies and all is more relied on government, because those guys can't sell the arms to others, correct? They can only sell the arms and guns to whom? Only to the government. What if the government want to switch the tender from this company to other company? You have to shut down. So that means you are more relied on government. So the quality of earning will be low. Why? Because your source is one single source. If you lose the contract, you lose the company. So the business environment means it says where you are working, who's the competitor is, what is the regulatory and legal environment you are there. Okay, so that is called as business environment. Inflation is also into the, if you are in a high inflation country means, okay. And foreign risk, if you are doing a more transaction in foreign currencies, so you're exposed to foreign risk, okay. Next, the accounting principle. One more, another factor of earnings quality is accounting principle. See, sometimes the company might use conservative accounting or aggressive accounting. If the company is using aggressive accounting, lower quality of earnings. Conservative accounting, high quality of earnings. Conservative accounting means you report your income low to be safer. This is considered as high quality of earning because they don't do over promise. Conservative is not like overstated. We'll earn this. We have earned this. No, whatever earned, we'll report it. Aggressive means doing all this, like playing with the numbers and all those is called as a aggressive. Aggressive means low quality, okay. Third one is character of the management. Character of the management means if they are playing with asset liability games, they are playing with the numbers, fraud and misrepresentation. Majorly this company analysts found out this guys are doing fraud and misrepresentation means the quality of earnings is low. Clear? See, it depends upon how the managements are getting paid, okay. If the managements are getting paid based on the profits, right, they will try to manipulate the profit because their bonuses and incentives or commission is based on the profit, so they'll play with the profit, okay. So that affects the earnings quality. Now next, what is earning persistence means? Earning persistence refers to how stable and constant your profit are or your income. It is not like 1 year you make 1 million, 1 year you make only 50,000, and next year you see you made like 800,000. So whenever this stableness is not there, there is no earning persistence. The more the earnings are predictable, you are having high quality of earnings. How? Slowly 10%, 15%, every year's growth is there, right? That is fine. 1 year high, next year tomorrow you are falling, again growing. The volatility, if it has a high volatility means it is not having high quality of income, okay. Clear with this? So these are the determinants of earning persistence. One, earning variability, how wildly the profits are swinging, like it's going from year to year, how it is going. Earnings trend, so when you zoom out to 5 to 10 years, what is the core direction of the profits, from what is the trend of the profit you are having. Management incentives, just how I told, how the CEO and executive teams are getting paid, that depends upon the, these are the determinants of earning persistence. Next, earnings management. So this is when management uses accounting loopholes to artificially smooth out the numbers of the company look more stable. They use all these tricks. These are some tricks they use to play with the numbers. One is what? Understating the reporting earnings by creating the reserve. 1 year they made a good profit. What they'll do, they'll not show. They'll separately keep it somewhere and hide it. Income smoothing, which is like a part of earning management. So what they'll do, they'll keep it somewhere. Now next year when they have a dip, a profit is going down, they'll show this profit then. So what happened? You are showing with the investor, yes, we are stable company, which we are not like 1 year profit, 1 year loss. Now what happened? You are matching with last year. So this is an earnings management, low quality of earning. You are playing with the numbers. Change accounting methods and assumptions. Keep on changing the methods. Keep on changing the estimations. Whenever you are in high profit, high credit loss estimation. Low profit, low credit loss estimation. That one. Removing the effect from unusual gain and losses from offsetting with some other discretionary number or expense item. Some unusual gains and losses will be there, right? That effect you are removing from the income statement. Okay, with some other discretionary income or expense item. Okay, recognizing future period in current period. All these things, they're playing with the numbers, right? That is earnings management. timing the expense, write down of the operating asset. When you write down the operating asset, the return on investment will be high. Why? Because how the ROI is calculated? Income divided by asset. Now you write down the asset, denominator is going down. When the denominators go down, what will happen? ROA will increase. So you should see we have made this much ROA. You written down the asset value, because of that asset went down and you're showing this much profit you made. And aggressive accounting method. So these are what? These are some examples of earnings management. Clear with this? Okay. So done with your section A. So we did with all the topics which we need to cover. Okay. So next we'll start with section C. So today we started from where? International finance. International finance, again we broke down into two. One only for transaction and another only for parent subsidiary. What are the three currencies we reported there? Recording currency, functional currency, reporting currency. From recording to functional, remeasurement, functional to reporting, translation. And temporal method used for remeasurement, current rate method is used for translation. Done with that. And whatever the gains and loss in the remeasurement, where you will report?
Income from continuing
Operation. And this one from the translation, AOCY, accumulated other comprehensive income in the balance sheet. Done with that. Next we started with a small topic, inflation we did, accounting and economic profit, and then in between that we did accounting changes. Three changes: principal, reporting entity, and change in the estimate. So principal and reporting entity we use retrospective, estimation we use prospective, and change in, like if you do some error, do the restatement. Error is important because error you will not do from earlier year. Error is not rectified in the future year. Only where you did a mistake, that go and rectify it. Adjust in the retained earnings. Okay. Then yeah, earnings quality. So these are the theory topics which you have in the section A. See, please go through this topic. Okay. Clear with this? Okay. Fine. We'll take some break and we'll come back and we'll start this. Okay, we'll start with section C, business decision analysis. Okay, so section C we can break into three parts, where first part will go with CVP analysis, then marginal analysis, then pricing. Okay, so section C is completely related to your business decision analysis, where you can take the decision in your business whether to do this or whether not to do this. Okay, which option is best, either if option A is best or option B is best, whichever it is. Okay, so in the CVP analysis we are just discussing about the cost, volume and profit. What is this cost, volume and profit means? So whatever the company you're producing, right, your company might be producing multiple goods, multiple products and services you might be giving. So in this we are going to check which one is giving more profit and how much you have to sell to reach some level of profit, or at least a break even. In this topic we'll understand. So CVP is used for only short run decision. Short run decision, the CVP is used. Why? Because so in the short term, how much products you have to sell to achieve the break even or to achieve this profit. So known as CVP analysis. So, but there are few assumptions in the CVP. So what are the few assumptions in the CVP where we will tell either the cost is what, fixed cost or variable cost. We'll discuss what is fixed and variable cost. Okay, so in the what is the first assumption? There are only two costs, either fixed or variable. Next, within the relevant range, the total cost and revenue are predictable. We know all the things within the relevant range. We know all the what was going to be revenue, what is going to be the output and everything. Next, total fixed cost and the selling price per unit, variable cost per unit and the sales mix remain constant over the time. So what and all will be constant? Selling price, variable cost. See, selling price and variable cost will be in per unit, fixed cost will be in total and the sales mix will be constant. And production is equal to sales. There will be no ending inventory. No ending inventory. Whatever I produce, I will sell. And the time value of money is ignored. No need to worry about this time value of money. Okay, because in section B and section E we'll discuss about the time value of money, but in the section C no problem with the time value of money. Okay, now first we'll understand what is this contribution margin. I think yesterday also when we were discussing something, this contribution margin came. So the contribution margin means what? What is contribution margin? If I'm selling something for 100 rupees, all the variable costs in the sense both manufacturing variable cost, non-manufacturing variable cost, if I am minusing, the rest of the amount is called as contribution margin. Okay, now what is this variable cost? So variable cost means a manufacturing or a non-manufacturing cost which changes as per the volume. If I'm selling 10 units, I'll have a different cost. If I'm selling 100 units, I will have a different cost. Why? Because here the cost is dependent on the volume. Cost is dependent on the volume. So variable manufacturing cost or cost per unit produced, and variable selling and administrative cost or cost per unit sold. It might be manufacturing or non-manufacturing. So to produce each unit, what is the cost is incurred is known as variable cost. Example, so sell 1 cup is equal to $2 cost. If you sell 100 cups, it will be $200 cost. Why? Because I told the cost is entirely dependent on volume. So here per unit cost will be same. Per unit cost will stay same, but total will change. In total what happened? Variable cost total what happened? Variable cost total will change. but per unit variable cost will be same. Okay, clear with this variable cost? Now we'll go to the fixed cost. In the fixed cost, what it is, it doesn't depend on the volume, opposite of variable. Whatever the volume is, if it's within the relevant range, whatever the volume is, the cost is going to be stay same. So the total fixed cost will be same. Total will never change. But as per the unit you produced, the per unit will change. As per the unit produced, the per unit will be changed because the denominator will fluctuate. Okay, example. The rent you pay 5,000 whether you sell 1 cup or 10,000 cup. The rent is still same. But the per unit now, 5,000 into 1 cup means for 1 cup it handles 5,000 of rent. But if you are selling 10,000 cups, so the 5,000 divided by like 10,000 cups, we can divide it. So that is what a fixed cost. And what can be a variable cost in a restaurant? The raw materials they use, like rice, whatever the flour, whatever they will use as a milk or coffee powder, whatever they use, that will change based on the plates, how much they are serving, cups, how much they are producing. But the rent will be same, and the salary also it will be same. Okay, so that is fixed cost. Okay, now there is something called as a relevant range. Relevant range means within that range it will be fixed. Now this is what we were telling, contribution margin. So contribution margin formula is what? Selling price per unit minus variable cost per unit is equal to contribution margin per unit. See, in this variable cost, to confuse you, they will give multiple variable costs. So all the variable cost, which means manufacturing and non-manufacturing, both will come. Clear with this? Okay. So the total contribution margin calculated in two ways. How to calculate total contribution margin? So now you calculated unit, right? Multiply by number of units sold. So on each cup, on each coffee cup, I'm earning contribution margin of $1. If I sell 10,000 cup, 1 into 10,000. So I will earn $10,000 of contribution margin. Or total revenue minus total variable cost is called as contribution margin. I'm writing total, everything in total. Suppose each cup we are selling for $5. 1 cup I'm selling for $5. So I sold 10,000 cups. So how much it will be? 50,000. And now, on each cup I am incurring a variable cost of $3. So how many cup I sold? 10,000. 20,000 is what? Total contribution margin. And $2 is what? Unit contribution margin. And if I multiply 2 into 10,000, what it is? Again 20,000 only. Either I can take 2 into 10 or directly 50 minus 30. My contribution margin I can get. Clear with this? Okay. Now contribution margin ratio means the format you take. See that format in your like sales minus variable cost is equal to contribution margin is there, right? Sales minus variable cost is equal to contribution margin. Now contribution margin ratio means what you have to do? This one, contribution margin divided by sales. See, gross profit margin yesterday we learned, right? Gross profit divided by sales. Contribution margin means contribution margin divided by sales. If it is per unit also you can take in total also. Example, we'll go through this example. Now in this, what is my contribution margin? 20,000. What is my sales? 50,000. And we'll go for per unit. Per unit contribution margin is how much? 2. What is my sales? Like per cup for how much I am selling? 5. Now 2 divided by 5 is how much? Think 40%. Here also it will be 40%. On both, either you go with per unit, either you go with total, the contribution margin ratio will be same. Clear with this? because this again it will come, right? This contribution margin ratio, contribution margin per unit will again come. See, this is how the income statement look like. See, yesterday we saw an income statement in the section A, completely different. In the section A, how the income statement was: revenue minus cost of goods sold is equal to gross profit, operating expenses is equal to operating income. It was like this. But here you see, sales minus variable cost is equal to contribution margin minus fixed cost is equal to operating income. So this should be in your mind. It should be set, because we'll be CVP analysis will be playing with this only this 4 to 5 items. Clear with this? Okay. This is how, see, whatever the number of units I'm selling, my fixed cost will stay same. If my fixed cost is $10,000, if I sell whatever I sell, my fixed cost is 10. But variable cost will change based on the number of units. See, number of units increase, variable cost is increasing. See, here it was, now it is like this. Clear with this? So variable cost will change, but fixed cost will stay same there only. Okay. And if we add total cost, what will happen? What will happen to total cost? Total cost will also change, because in the total cost, what is there? Variable cost is there. Because of the variable cost is changing, total cost will also change. And you can write in this format for the total cost: y is equal to a plus bx. A means fixed cost. Okay. B means variable cost per unit. This is total fixed cost. Variable cost per unit. X means number of unit is equal to total cost. In the format of this, if you write in the algebraic format, we can write like this: y is equal to a plus bx. Okay. So in this, what I can do, you can change the number of units and understand how your total cost is changing. Now we'll come to a place called, see, now total cost reached here. Now my cost reached here. So this might be example thing, assume that this is 40,000. Now revenue starts from 0 and it reached here. When the revenue is equal to total cost, I'm not telling variable cost and fixed cost. Total cost means what and all cost came, variable cost also came, fixed cost also came. So revenue minus total cost is equal to what? Sorry, when the revenue minus total cost is equal to 0, it is called as what? Break even, where no profit, no loss. See, at this point, revenue and total cost is equal. They are meeting at a line. So which means it is a break-even point. Clear? Now, the questioner might ask you two things regarding the break-even. They might ask you to provide break-even in units. How much cup of coffee I need to sell to reach the break-even point? Or they might be asking you in revenue. How much dollar of money I have to make to reach my break-even point? See, it's simple as that. Whatever is equal to total cost is your break-even. Whatever is equal to total cost is break-even. Now first we'll understand in units. Units means it doesn't have a dollar symbol or nothing. It will be in the type of cup, how much shirt, how much furniture, how much units I have to sell. So the formula is this. So break-even unit formula is total cost divided by contribution margin per unit, or unit contribution. See, we learned two things before reaching here. What are the two things we learned? Contribution margin we learned, and what else? Contribution margin ratio also we learned. Now to find in units, what you will apply? Unit contribution. Okay. Now take this example. Company were selling this for $60. Variable cost was $35. So then what will be the contribution margin? 25. And they were incurring 1,50,000 as a fixed cost. So now I will understand this. Fixed cost is how much? 150 numerator divided by unit contribution margin. For how much I was making on each wireless router? On each router I sell, I'll make how much? 25. So 25. So 150 divided by 25. Whatever you will get, it's not in dollars, it's in units. Which means I have to sell 6,000 units. Now we'll verify this 6,000 units. 6,000 units I'm selling. For how much dollar? $60. And 6,000 units I'm selling. On each $6,000 there is what is also there? Variable cost is also there. How much it is? 35. Then you will get contribution margin. How much is the contribution margin? It will be 25 into 6,000. Because 60 minus 35 is equal to 25. So how much is 6 6 are 36? Correct? Correct? And next 6,000 into 35? 2.
20.
Okay. 2 10,000. Now remaining 25 into, so 1,50,000. So this 1,50,000 is what? Contribution margin. Now just we learned this income statement, right? We apply it here. So what was my contribution margin? 1,50,000. And what is my fixed cost in that question? What will be my operating income then? 0. Because my contribution margin was how much? 150. I earned 150. Then fixed cost took 150. So my profit is 0. See, whenever they are asking the profit, right? No need to write all this. You can directly start from contribution margin. How? You know what is the contribution margin per unit? 25. 25 into 6,000 you start. 150 you will get. Because you started with contribution margin minus the fixed cost, directly you are reached with profit. Rather than doing all this, start from the contribution margin. Okay. In units is sorted. Now in revenue, one simple step is you understand from the units, right? How much you have to make in the units. How much you have to make in the units? 6,000. And what is the selling price? Because they are asking how much I should earn in dollars. So what was the selling price of the product? 60. So how much it will be? So this much revenue if you make, you will have a break-even point. Your break-even is 0. This is in revenue. So how you can find the revenue? Selling price into break-even in units. One is this method. But other one, if you want to get it directly without going in this way, we have to find what? Contribution margin ratio. How to calculate the contribution margin ratio? Unit contribution margin divided by unit selling price, or total also you can keep. Ratio is easy. What is the contribution margin? 25 divided by 60. So what is the contribution margin ratio we'll get?
0.416.
This is the one you will get. By using this, you can get the break even in revenue. How? What is it? Total. See, the numerator is not changing. In the units also, and in the in revenue also, numerator is fixed cost. How much it is? 150. But what is the denominator? It is the ratio. How much is the ratio we got? 0.416. Calculate it. 360. 576 you will get. But because of the decimal you are getting like that. You are getting 360, right? 360. Because 0.416 will be 360. But if you do m plus, you do one thing. Take your calculator. Click. What is the contribution margin? 25. Divided by. What is the selling price? 60. You got 0.4166667. That is what? That is your contribution margin ratio. Now click on M plus. Okay. Then click on AC. You have AC option, all clear. Click on that. Okay. Now we'll go and work on this formula. Which formula? This one. What is it? What is the fixed cost? 150 divided by MRC. Click on MRC and then click on is equal to, you got 360, right? You'll get 360 in your calculator. The exact number you will get. See, I just went 150 divided by MRC. MRC we already saved in the 0.667, right? So if you click is equal to, you exactly get 360 in your calculator. Okay. Then because this MRC, once they used, you can double click on it and you delete it. Because for the next calculation, if you do again M plus, right, this will again, it would have added. So for that, once the job is done, right, double click on MRC, it will get deleted. It's nothing but memory clear you are doing. Clear with this? Clear with the break even in sales? See, now they have given in revenue. Now you want in units. What you can do? See, revenue we have divided by selling price. Then you will get 6,000. See, to get revenue, what you did? Multiply by number of units, you will get revenue. But divide by the selling price, you will get number of units. Clear with this? Okay. If you are doing in total or break even in per unit also, you will get the same. Okay. So break even sales revenue divided by selling price per unit. This is what we did. Then you can get what? Break even in volume you can get. The one we did right now. What was the break even in break even sales revenue? 360, right? Selling price was 60. Then you will get the volume as 6,000. All these things are interconnected. Clear? Okay. Now where and all we can use this decision, where and all you can use this CVP analysis is, you can understand how many units need to be sold to justify the expenses. Suppose we are bringing some marketing expense. Assume that we bringing 5,000 as a marketing expenses. To cover at least this marketing expenses, how much units we have to sell extra? Your manager came, he is telling us we are going to invest in marketing $5,000. By investing this, we can at least sell 1,000 units extra. But the contribution margin is how much? 10. Then how much it will be? 5,000 divided by 10? 500. If you have to sell what? You have to at least sell 500 units to cover this. But if you are able to sell 1,000 units, fine. If you are able to sell only 100 units extra, means don't do it. Because to at least this marketing, you have to sell how much units? 500 units. By this you can understand. See, this is a fixed cost, this is a contribution margin per unit. Because this contribution margin per unit has a power to cover your fixed cost. Selling price doesn't have a power to cover your fixed cost. Because in selling price, who will take? Variable cost will take and go. The left amount, which is called as contribution margin, it has a power to cover your fixed cost and give some profit. Okay, it starts from selling price only, but in between that, who is there? Variable cost is there, which is eating your selling price. Okay, what is the effect of changing the prices? Suppose if I change the selling price, obviously whenever I decrease the selling price, what will happen? I can sell more. But in this you can understand, when you sell more, what you are losing? Contribution margin you are losing. I'm not telling selling more, contribution margin you are losing. Whenever you reduce the selling price, contribution margin per unit you are losing. So you have to understand whether it is justifiable to reduce the selling price or not. So like this, and also to take some decision. You are bringing some new product. In the market, we know that this product can be sold 5,000 units, we can sell easily. But after doing the break-even analysis, you understood at least you have to sell 7,000 units. to reach the break even. But the market demand is how much? Only 5,000. So what you have to do? Don't do anything. Correct? Because break even is 7,000 units you have to sell. But you are able to, but the demand is how much? 5,000. Okay, what happened now? You can't sell the extra 2,000 units, so you will be in a loss situation. Okay. Now, we did all this. Now we just need to now break even till we are happy. Now next we want some profit. We have some profit plan. So the profit plan might be in dollar, might be in percentage. What is in dollar, what is in percentage means, suppose my company is telling we want to make $50,000. This is called as what? In dollar amount. Or the company is telling we want 10% of profit. 10% of profit means it refers to selling price, because how the net profit is calculated, what is the net profit margin formula? Yesterday we net income divided by sales. So it depends upon the sales only. So they are telling 10% of the profit I want. One is what method? One is a direct dollar amount they gave. One is what they are giving? They are just giving the percentage. Okay. If the dollar amount is given, what we have to do, we'll see. It is easy when the dollar amount is given. Consider, if they are giving as a direct dollar amount, consider this as what cost? Fixed cost. Consider this as fixed cost. See, the required dollar amount of profit is treated as fixed cost. Okay, I want what? I want some profit, right? Put next to the fixed cost. Break even formula, you know, fixed cost divided by break even. Now next to the fixed cost, what you have to add? The dollar amount, whatever you want. So if it's in units, same, the formula doesn't change. In units, what is the denominator? Contribution margin per unit. But if in the revenue, what is the denominator? Contribution margin ratio. What is the formula for contribution margin ratio? Contribution margin divided by selling. Now, denominator is same. Don't worry. Break even, same denominator you take. For units, units denominator. For revenue, revenue denominator. But if it in the numerator, what you have to do? Just make one change. Add target pre-tax income. So in the, I told, right, we want to make how much? 50,000 extra. Consider that as 50,000 and put it here. But it should be pre-tax, okay? For post-tax, we'll tell you. But it should be what? Before tax. The company is telling before tax, I want to earn 50. If the company is telling after tax, means first we have to convert into before tax. We'll see in the next page what it is. So whatever it is, it should be before tax. It shouldn't be before, because before tax only we should keep here. So before tax, how much I want to earn? 50. And I will pay from this tax, I'll pay happily. But now I want to earn how much? 50 before tax. So just you have to add the profit next to the total fixed cost. Example, we'll take one example. The company is having contribution margin of $50 per unit and selling price is $80 per unit. Fixed cost is $120,000 and pre-tax profit we want to earn is $40,000. Okay, now tell me in units and tell me in revenue. See, in units, what should be the denominator? Contribution margin per unit. And in revenue, what is the denominator? Contribution margin ratio. Then go and find the ratio. 50 divided by 80. Contribution margin divided by selling price is the ratio. 0.6. Just 0.6. 0.625. Now for the break even, what was the numerator? Fixed cost. Either in units, either in revenue, it was the numerator. But next to that, just add this profit, your target, What is your target now? 40. Add the target here. Enough. So how much it is? 160 divided by 50. So you will get in units. So I have to sell how many units? 3,200 units. And here how much revenue I have to make? $256,000. Correct? Either way I can do like this or multiply 3,200 into selling price. How much it will be? 3,200 into 80. Again, it should be 256 only. Okay, no compromise. Clear with this? Just what you have to do, one step. Next to the fixed cost, add the pre-tax income. Clear? This is when it is in the even, yeah, pre-tax. It is when they are given in amount, not in the percentage. Now they have given one example, another example. They have not given pre-tax. They are told, I want to earn income after tax. I mean post-tax. See, whenever they give post-tax, what is the first step we have to do? Don't worry about anything. Don't worry about the fixed cost, contribution margin, nothing. Convert the post-tax into pre-tax and keep it. Then same thing. What we did here, do again the same. Example, like we earned a contribution margin $65, selling price $95, and what it is, fixed cost we have like 145,000. Post tax profit, not before tax. Okay, after paying the tax, I want to earn how much? I want to earn 1,90,000. After tax, I want to earn how much? 190. But if they are telling the tax means what I want there will be a tax rate. So tax rate, assume it is 30%. Now tell me one simple question. This is 190 after I have to earn after tax. So before tax, it will be more than 190 or lesser than 190? If it is lesser than 190, after paying the tax, it will be more or lesser. So my post-tax profit is 190 means this is after paying the tax. So before paying the tax, it should be more. See, if 2,50,000 is there, after paying tax, I'll be having 190. So in my mind, it should be more than 190. So what happened? Whatever the answer you get, so now you can get convinced. If it is more than 190, yes, I'm getting, because it is there. So how to convert the post-tax into pre-tax? What is my pre-tax? In post-tax I have to earn? How much I have to earn? 190. So 2, yes, 190, or I can write in the formula, post-tax profit divided by 1 minus tax rate is equal to pre-tax. Post-tax profit minus divided by 1 minus tax rate is equal to pre-tax. We'll see this. Okay. Now, what is the post-tax profit? 190 I have to earn. 1 minus tax rate is how much? 1 minus 0.3. See, 1 minus 0.3, denominator is how much? 0.7. Ultimately, this is how much? 0.7. So 190 divided by 0.7 is how much? 2,71,428.57. Okay. Now, this is what I have to earn before tax. But just we need to verify once. How we'll verify once is, what if after paying the taxes, how much it should be? Guys, after paying the taxes, how much it should be now? It should be 190. We'll just verify this. Assume that we earn 271,428.57. How much we have to pay the tax? 30% we have to pay the tax. So what is the 30% of this? 81,428.57. Correct? Now we'll pay the tax minus 81,428.57. 271 minus 81,428.57. How much it is? 190 profit. So this is like EBT minus tax PAT, profit after tax. See, we want 190, right? We got 190. So this is how you can verify once. If you want to verify, just for the verification purpose. Now what we did, first step what? Convert pre-tax into, convert post-tax into pre-tax. You converted post-tax into pre-tax. How much is that? 271,428. Now what we have to do? Do the same which we did in the pre-tax we did, right? The earlier question. What we did here, same we'll do. Now we'll find in revenue and we'll find in units also. So what is the units formula here? The formula doesn't have any change. Again, the formula is same. What is the formula? Fixed cost plus pre-tax profit divided by contribution margin per unit. What is the contribution margin per unit we'll earn here? How much? 95 minus 65. 30. And what about the ratio? We can calculate in revenues also. So how to calculate the ratio? Oh, sorry. This is already in contribution margin. We'll do one thing. We can keep the contribution margin as 30. Okay. So now contribution margin is how much? No. This is contribution margin, not variable cost. I have not given the variable cost, directly gave the contribution margin. Then it will be 65 will be the variable cost. That is not required here. So now contribution margin ratio we have to find. How to find that? Contribution margin divided by selling price. How much it is? 0.3157. We'll keep all these items here ready. And now we'll go to the formula. So in units, to put in units what we want, contribution margin is required, 30. And in revenue what we want, contribution margin ratio is required. How much it is? 0.3157. Okay. Now what is the fixed cost? 145. That same I can put on both the side. And what I have to add now? Post-tax or pre-tax? Pre-tax. Because they gave post-tax, but we converted into pre-tax. What is it? 271,428. So how much in units? So add the numerator. 145 plus 271,428. It will be 416,428 divided by 30. So you have to sell 13,880 units to reach your profit. And here, how much you have to sell? Divided by 0.3157. You have to make a revenue of $1,319,062,000. This much revenue you have to make to reach your profit. Clear? Now, if you want to verify, we can verify. 1,319,062 is the revenue, right? What is the contribution margin ratio? Because multiply the contribution margin ratio, you will get directly contribution margin in dollars. So what is the contribution margin? 0.3157. How much it is? $416,428. What is your fixed cost? 145. Because contribution margin minus fixed cost is what? Pre-tax income. Correct? See, What is the pre-tax income I want? 271, 428. Then we know that you pay the tax of 30%, 190 is your profit. In the calculator, it is easy to do, like 271, 428 multiply by 30% minus it and click is equal to, you will get post-tax. Clear with this? Okay. Now done with the first one. Pre-tax and post-tax is done. Now we'll go to the second one. Second one is what? They are not giving the amount. They are just telling the percentage. See, whatever you earn, we want this much percentage. The target is what? Based on the percentage. Whenever it was in amount, what you did? You consider this as fixed cost, right? But whenever it is in percentage, you consider this as variable cost. Sorted. So whenever you consider this as variable cost, it has an effect on your contribution margin. So that contribution margin will help you to make some profit. We'll see this. First we'll do pre-tax, then we'll do post-tax, then we'll convert into pre-tax. So first step, there are multiple steps in this. The first step in the percentage method is take the percentage of revenue and multiply by selling price per unit. One example I'll give. We'll start with example. Assume that they want to make 10% of profit pre-tax. How much I want to make? 10% of profit. See, that is in percentage. Go and find the dollar value. Example, selling price. We are selling prices $90 and the variable cost is $60. Then the contribution margin will be $30. But here we have one twist. We can't take this contribution margin in our calculation because we have to adjust with. Then we take the fixed cost, take $1 lakh. Okay. Now, first step is to identify what is this 10% should be. Now, what is the target of us? Earn 10% of the selling. Whatever the sales you do, we earn how much? 10%. So first go and check what is the 10%. So take the 10%, our target, multiplied by selling price. How much it will be? $9. First we have to do this. Target percentage income of revenue into selling price per unit. Got it? Next, adjust in the contribution margin. What we have to do? Adjust in the contribution margin. Now, what is your contribution margin? Normal contribution margin is how much? 30. Consider what you should consider this as. Consider this as variable cost. See, if it is considered as a variable cost, your contribution margin will go down. Now, normal contribution margin is how much? 60. If you consider this as a variable cost, your contribution margin will go to 69. Then what will happen? Your variable cost will become 69. Your contribution margin will go down. So better than we are not disturbing anything, whatever the format is written. They give the format. We first step is what? Go and find the dollar amount. Whatever the contribution margin they gave, will minus this. Which this in the step 1 we got some amount, right? Will minus. How much it is? $9. So this 21 is called as what? Adjusted contribution margin. Clear? Then step 2 is done. Step 3. Normal, we'll go and find the revenue and units. But in the first method, in the amount method, you have made a change in the numerator. Fixed cost plus target profit, pre-tax profit. Here you are not going to make anything in the numerator. Numerator, let it be that same. Fixed cost, let it be fixed cost. But denominator will not be contribution margin. Denominator will be what? Adjusted contribution margin. So we'll go and find what? In units. So normal, what is the formula for break-even formula? What is the numerator? Fixed cost. Divided by what? Not contribution margin. The divided by adjusted contribution margin per unit. Then you will get in units. Now we'll come to revenue. Again, revenue, what will be the numerator? Fixed cost. But here also you want to find what? contribution margin ratio. But here we are with some target of $9, right? Here we have to find adjusted contribution margin ratio. How to find the adjusted contribution margin ratio? What is my adjusted contribution margin? 21. What is my selling price? 90. So what is my adjusted contribution margin? 21 divided by 9. Contribution margin is how much? 21 divided by 90 is equal to 0.3333. This is what? Adjusted contribution margin. This is used to find what? Revenue. So we'll put that here. Sorted. Now you go and find what is the income in units, what is in dollars. 1 lakh into 21. So 1 lakh divided by 21. 4,761 units. And in dollars, 428,571, right? 428,571. I took all that 0.23333. I did M plus, right? Because if I'm writing and doing, two things can happen. One will miss out in the option, there will be some difference will be there. That extra split second will miss. So if it is in M plus, I no need to write anywhere. I'll put in M plus, then I'll use this calculator only. Rather than writing and then going the division, is little bit tougher. In the calculator only we can do. So this is the revenue we want to make to achieve 10%. Okay. So if you want to verify, we'll verify this. So 428,571 multiplied by not adjusted contribution margin ratio. What is the contribution margin ratio? We'll have 30 divided by 60. How much it is? Sorry, not 60, 90. 0.33333. So 428,571 into 0.33. You will get contribution margin ratio. You will earn how much? 142,856. And what is your fixed cost? 1 lakh. And what is your profit? 42,856. Now 42,856. Now you are verifying whether you achieve 10% or not. How to verify? 42,856 divided by 428,571. Almost I'm getting like 9.9927. That is because of the decimal, but you achieved how much? 10%. The questioner asked how much percentage? 10%. We achieved 10%. Done. That's it with the, see, the same formula break even we used. If it is in dollars, numerator you make some change. If it is in percentage wise, denominator, take the contribution margin and bring what? Adjusted contribution margin. How to bring the adjusted contribution margin? Contribution margin minus what? Your target. Okay. Now this is what? Everything is what? Pre-tax. Now this is given in a post-tax. You have to earn this much percentage they gave. What they gave? Yeah, you earn targeted after tax net income per unit. They have given. So then what you will do? Same thing only. First go and first step, don't do anything. First step is still same. We'll check this one. Okay. Take this example. Selling price $140. Contribution margin $50. Okay. Now we did for pre-tax, right? Now we'll do an example question for post-tax. Post-tax, you want to earn 15% of sales. How much you want to earn? 15% of sales. Next, what we have? Fixed cost $250. Okay. Now again, no any compromise in the first step. First step is same. How much you want to earn? 15 percentage. Of what? Of sales. How much it is? $21. Correct? No, you did this. This is pre-tax or post-tax? Post-tax I want to earn 21. Post-tax I want to earn 21. Then the pre-tax will be more than 21. So now convert the post-tax into pre-tax. Then go and adjust your contribution margin. So last whatever we did, one extra step is what? First step is same. What is the amount you want to get? Because they will give in percentage, you want to get in amount. That amount you take and convert into, okay, I'm not given the tax rate. So tax rate is 30 percentage. So again the same what we did in last problem, right? 1 minus tax rate. So how much it is? 0.7. So post tax how much you want to earn? 21 divided by 0.7. You want to earn $30. Now this $30 you will go and adjust in contribution margin. So now normal contribution margin is how much yours? 50. Normal contribution margin is 50. Now after adjusting this, your adjusted contribution margin will be 20. Then you know what to do rest of the thing. Fixed cost 250 divided by 20. You will get in units. And if you want in revenue, 250 divided by contribution margin ratio, adjusted contribution margin ratio. How to get? 20 divided by 140. So adjusted contribution margin ratio will be 14.2 percentage. So use that, you will get in revenue. 12,500 units I have to sell, and in terms of revenue I have to make 1,765,000. So easy, one simple steps you have to do. See, when you more practice questions, right, you will get this automatically. Pre-tax, so post-tax, convert into pre-tax. That mindset you will get once you see this. Clear with this?
We do the 12,500.
Then also you will get. Which one? 12,500 into selling price also you do, you will get the correct answer. What is the selling price? 12,500 into 140. See. That is because of you're not taking the full decimal, right? What is the contribution margin you are having? Adjusted. 20 divided by 140. Okay. Now what is here? 250 divided by MRC, 1,750,000. You see? That is because of the decimal we are using here. So if I want to take exact, 20 divided by 140 is what? If you want to write 0.4285174 this much, it will be there. But as in the calculator, if you use 250 divided by this amount, you get exactly 1,750,000. Because for the 1 million and all, 10,000 is not that big difference. The decimal we are not taking the complete decimal means yes you have. That is the reason I told just go with the MRC. It will be very easier. You will not get confused also. Okay. Done with the profit, done with everything. Clear till here? Okay. Now another topic is what? Multi-product CVP analysis. Now we saw everything for one product. What if the company is having more than one product? Few steps are there. If you follow the steps, you will reach it. Okay, so we'll do this. See, the multi-product calculation, what and all we want? We want in quantity and we want in revenue. Here also we want in quantity, here also we want in revenue. But there is no one break-even point here. Why there is no one break-even point? Because we are selling multiple products. When we are selling multiple products, there will be no one break-even point. Okay, we'll take 5 minutes break and we'll start this multi-product CVP analysis. We'll do one thing. We'll come back at 12:10. Okay. Okay. So multi-product CVP analysis is whenever a company is selling or producing and selling more than one product, this multi-product will come. But in the assumption as we learned, so the sales mix will be constant. There will be no any problem with the sales mix. The sales mix will be constant. In order to calculate the BEP with multiple product, we use basket instead of units. Now we were telling units, contribution margin per unit, contribution margin per unit, right? Here, okay. So in the multi-product analysis, rather than we are using contribution margin per unit, here we'll convert that into contribution margin per basket. Now, we know that contribution margin, like break even, will be one break even point, but here there will be no one break even point because we're not selling one units. So now company is selling smartphones and iPads, smartphones and tablets, or they are selling the headphones and all. So each product will have each break even points. Okay, and how that will understand? We'll split the break even point based on their weightage. Okay, so here also we have two things to understand. One is sales quantity mix and one is sales revenue mix. Sales quantity mix means then we have to find the dollar amount of contribution margin per basket, because quantity means units means it should be in the dollar. If it is a revenue mix, contribution margin ratio for the basket, then we have to find what? Contribution margin ratio we have to find. If they are giving a sales quantity mix, then what we have to use? Contribution margin per basket you can use. But if they are giving the quantity mix and asking to find the revenue, still you have to do the contribution margin per basket only. Okay. Now sales quantity mix will go through. The first one, calculate the dollar amount of contribution for the basket. Calculate the BEP for the number of basket. How to do this? We'll understand. See, first step. Now we have to find what? Break-even point. The first step in break-even point is what? To find the contribution margin. Then fixed cost divided by contribution margin need to be done. Okay. So for this, we'll go and find the contribution margin of each unit first. Example, the company is selling what? The last month, the company sold 8,000 black coffee and 2,000 latte. So here, the company is selling 80% of sales is coming from the coffee, 20% of the sales is coming from the latte. So we can understand the weight here. The weight they have not given in terms of dollars. Dollar weight is different. In units weight is different. They are given in weight is what they are given in terms of units. If they give in units, you just need to find what? Break even in units. You can't find the mix by using the units. You can't go and find for the revenue. Find for units. So how much is the units? 8,000, 2,000, which is 80%, 20%. The weight. Now you know the weight. Now you go and find the what is the contribution margin the coffee gives, what is the contribution margin the latte gives. Individual contribution margin. So what you'll do? Selling price minus variable cost of coffee, selling price minus variable cost of latte. So like that you got a contribution margin of $2 for the black coffee, and for the latte we got $4. Say their own contribution margin. This is a normal one which we do. Now what we have to do in the sales mix is multiply with the weight. Multiply with their own weight. Clear with this? So how much it will be? 20 into 1.6, 4 into 0.8. Clear with this? Any doubts? First step, understand the weight. Second step, calculate the contribution margin. Multiply the weight into contribution margin. Now you create the basket. Add the both 1.6 and 0.8. This is the average contribution margin of basket. Now the next is simple. Fixed cost divided by weighted average contribution margin. Clear with this? This is the third step. Then how much units you have to sell? 5,000. They just told here the answer is not completed yet. The answer is what? Sell 5,000. What you have to sell 5,000? How much coffee you have to sell? How much latte you have to sell? They didn't mention it. So now this is what a break even of the basket. Now what you have to do? You just split it. Split according to their weight. How much was the weight of the coffee? 80. 80% is coffee, 20% is latte. So 4,000 and 1,000. That's it. Clear with this? So step by step, if I want to tell. So first what you have to find? Find the mix. Find the weight. In the question only they will given. Explicitly it will be given in the question. But you just have to understand it. If it is not given, we'll go and find it. Next what? Weighted average contribution margin. How to calculate the weighted average contribution margin? Contribution margin into weight of the individual product. Third one what? Calculate basket contribution margin. How to do it? Weighted average contribution margin of product 1, weighted average contribution margin of product 2. If it is 3, 4, 5, 6, whatever the product is, you calculate it. Then what you will get? You will get the basket contribution margin. Then now what you do? Now find break even. How to find break even? Fixed cost divided by weighted average contribution margin. The total one. Total one you have to write. Then you will get what? You will get in units. Now last step is what? Split the units. Split units according to their own weight. Clear? These are the steps in terms of units. These are the steps. Okay. Any doubts? Okay. We'll go through this example. We have multiple examples. We'll go through this example once. See, they have only given the weight. What is the product weight of A? 40. Weight of B is 60. See, first, the very important thing is, what is this weight reflecting to? It should be in terms of units. Units means then only you can find the units. They are giving the sales mix as per the revenue, means you can't take that. So this is as per the weight is as per what? The weight is as per the units, because it says units of a company is 40, not revenue. Units of a company is 40 and B is 60. They have given 40 into 60. Next, what is first step is done. Weight is there. Second step what? Contribution margin they have given. You just have to multiply with their own weight. For the product A, what is it? 1.5 into 40%. For product B, 1.25 into 60%. Find their weight, individual weight. .6 for this, 0.75. Individual weight you got it. Now what you have to find? Weighted average contribution margin. 0.6 plus 0.75. So now you got the third step also. What is this? Basket contribution margin you got. Next, you know what to do. If you got the contribution margin, what it is? Fixed cost divided by contribution margin per basket. How much it is? 1.35. So you will get how much units you have to sell? 55,555.55 units. Fourth step is also sorted. Now we don't know how much product A need to sell, product B need to sell. That one you split based on their weight which we used in the step 1. So 22,223 product A need to be sold. 33,334 product B need to be sold. 40%, 60% split. Clear with this? This is one example. Other example, what you can do is you can create the basket. In that basket, you can only put some numbers. And example, if it is 40% and 60%, take 10 units. So product A will be 4 units, product B will be 6 units. Multiply with their contribution margin, not with the weight. Now they gave the percentage. Now that percentage you convert into units. 100% means 10 units. 40. 10 out of 40, 4. 66. Multiply with their contribution margin. What is the contribution margin? 1.5, 1.25. So how much it is? 1.5 into 4, 6. 6 into 1.25. 7.5. Now we will get what? Add this both. So in a basket, if I'm taking a basket, there will be 10 units. Okay. 4 units is from the A, 6 units from B. This 4 units is giving me $6. And the 6 units giving me $7.5. And the total basket is giving me 13.5 basket. Now we have to find the break-even point. How many basket? How many like this? How many basket I have to sell? So then what it is? Use this 13.5 and go with the fixed cost. What is the fixed cost? 75,000. How many baskets I have to sell? I have to sell 5,555 basket I have to sell. Now, in one basket, how many product A is there? 4. How many product B is there? 6. So I have to sell 5,000 basket and each basket have 4A. Then 5,000 into 4. 5,555 into 4. So again, it's same. 22,223. And 5,555.55 into 6. 33,333. Same answer, but different method, but the answer is same. Clear with this? If they give like this composite units, you should be able to solve this. Next is what? In revenue. So if they are asking in revenue, right, they have to give the weight as per the revenue. Now if you go through this example, what they have given? 40% of revenue, 60% of revenue. But in the last example, how they have given? 40% of units, 60% of units. So this one is okay. Same steps we have to use. But here, in revenue they are asking. So you have to calculate what? Contribution margin ratio. So first step is what? Understand the weight. 40, 60. Next step is understand the contribution margin. Contribution margin they have only given. Now, find the weighted average contribution margin ratio. How to find? Multiply this both. Multiply this 0.375 multiplied by 0.4 and 0.4167 multiplied by 0.6. I'm multiplying percentage with percentage. See, this is also in percentage. This is also in percentage. Percentage into percentage you have to do. How much you are getting, you see? 0.15, 0.25, total 0.4. Same we did with the units, right? Here also we do need to do the same. Now we have everything. Now we can go and directly find. What is it? 75,000 fixed cost. In this also it's 75. Yes. And what is the weighted average contribution margin ratio? 0.4. Now you will get directly in revenue. 75,000 divided by 0.4. So you have to make revenue of how much? 1,87,500. Yeah, we told you have to make 1,87,500. How much A should make and how much B should make? Multiply with their respective percentage. A should make 40%, B should make 60%. Here it is 112,500. Sorted. If they are given in units, which if the weight is given in units and they are asking contribution, this break even in revenue. What you have to do? You have to do this method. Normal units, you go and find the units. You'll get the units, right? At last multiply with the selling price. You will get in revenue. If the mix is in units, whatever we followed for units, we follow the units part. Then we'll understand what break even in units. Then multiply with the selling price. You will get from break even in units, you will get to break even in revenue. Sorted? Okay. Okay. This topic says, see, understand this two product. Product A is having what? High contribution margin ratio. But product A is having high contribution margin ratio. Ratio wise he is good, but unit wise this one is not that good. Here product B, ratio wise not that better, but unit wise making better. It depends, right? See, the $2 selling price, 0.5 you are making, 75% is what? So 0.5 is the cost, contribution margin will be 1.5. So ratio will be 75%. But if you see the amount, it's just $1.5. In this type of product, right, you have to sell, in terms of units, you have to sell more because the units is less. But in terms of revenue, you have to make little bit enough. But in terms of units, you have to sell more units because little bit of margin it is giving. But the second product, you see, in unit wise, you have to sell very less because you are earning more dollar wise. But ratio wise, it is less. So in revenue wise, you have to earn more. Okay. Now, suppose if you are shifting higher contribution margin ratio product and higher contribution margin per unit, what will happen to your break even? You have to, if you sell less is enough because you will reach your break even. Now, lower contribution margin ratio product, and that is also giving lower contribution margin in units. You have to sell more units, correct? You have to sell more. And now this is another conflict is, this product is having high ratio. What is having? High ratio, but low in units. If low in per unit, then you have to break in volume, you have to sell more. You have to sell more to reach there. But in revenue wise, if you're selling little, revenue wise, if you make enough little bit. Why? Because your ratio is high. Next, contribution margin ratio wise, it is low, but unit wise it is high. If you are selling high unit contribution margin product, break even will number of units, if you sell less also it's enough, you will reach there. But in revenue wise, you have to boost. Clear? Because your ratio is little bit. So this is a shift. Clear with this? Okay. Now we have risk and uncertainty in CVP analysis. In that, first one is what? Sensitivity analysis. Sensitivity analysis means what? Change any of this, sales volume, selling price or cost, and check what is happening with the profit and all. Example, in this we are changing with the variable cost. See, variable cost 20, 25, 30, 35 is there. We are just changing this and checking what is the impact on profit. See, when the variable cost is 20, we made 80. But when variable cost is just $15, we increased. You are making a loss of 10,000, which means 90,000 you are wiping out. 80 is going plus 10,000 is the cost. So sensitivity analysis means what? Changing any one of the variable and checking what is happening. Either you change the sales volume, selling price, cost, all this. Okay. Next, this concept is called as margin of safety. Margin of safety means it's a difference between the actual sales and the break-even sales. Difference between actual sales and break-even sales. Or it is a difference between actual or planned sales. If you don't know the actual sales, you can take it as a planned sale also. So that is margin of safety. See, if the break-even sales is 1 lakh and you actually sold 120, what is the margin of safety? 20,000. Because you have an extra buffer of 20,000 till you're reaching to your loss. Before you make a loss, you have an extra space of 20,000 which is covering from the loss. So your sales can go down until 20, not more than that. If it is going more than that, then what it is? It is loss. Clear with this margin of safety? Might be in units also, it is apply same. If it is units, also like margin of break even in units and actual units whatever you are selling. Clear? Okay. And margin of safety ratio formula is this: margin of safety divided by actual or planned sales. So in the example what I gave, margin of safety was how much? 20, and actual sale was 120. This is margin of safety ratio. Clear? And there is other decisions in CVP analysis. What is this other decision in CVP analysis is, here we are choosing between two cost options, two production options, variable versus fixed, and contribution, product mix under constraint. These three things are same. Okay. And the last one we'll discuss, product mix under constraint. So choosing between two cost option means you should be in an indifferent position. You should be in a position of indifferent by choosing this cost option. Okay. See, either I go this way or this way, it should be equal. That it is called as indifference point. You might get questions from this. It is indifference point. Indifference point is what? Either I go this way or this way, my cost or my profit or my income will be, everything will be equal. Okay. So we'll come to this, choosing between two cost option. Either I choose this option or this option, both the cost should be same. We'll see. Example. Now the company is having 45 employees. They are paying salary for them. So the average car sell for 35,000 and 6% commission is paid. How much is the commission they pay? 6%. Now one system where is completely variable. Complete variable I am telling is, they are not paying any fixed salary. Whatever you make a sale, that much you will get what? Commission. No salary. So if you do a sales, you will get. If you don't do a sale, you will not get. And now they are considering to change this to 2,000 salary per person. You say do a sale, you don't do a sale, we'll give $2,000 plus 3% of whatever the sales you do. So two things. One is what? Fully variable, and one is fixed plus variable. Now if you want to write this in the formula, okay, what is the salary I'm giving in one case? Okay, this one is what? 0.06, 6% of sales, but I don't know what is sales. Second, 0.03% of sales plus 2,000 into 45, which is how much? 90,000. Yeah, I'll make it as 90. Okay, equal to cost. This equal to cost. This is the cost of this. Cost of the company in the sales. Now you should find an indifferent point. Either I select this, either I select this, my cost is equal. Either I go option A or option B, my cost is equal. Based on that, I can take many decisions. Now to understand both the cost is equal, I'll write this in the equal side. 0.06 sales is equal to, this should be equal to this, right? 0.03 sales plus 90,000. Now what does it mean? This is equal to this. This is equal to this. But there is one thing which is blank. It is what? Your sales. If I do how much sales, both will be equal. If I do different sale, it will be not equal. In this point, in this particular sales point, my cost will be equal on both the side. Either I go if I sell variable, sorry, if I select the variable cost, or if I select the fixed cost, fixed plus variable cost, at this point of sale, my both the cost is equal. So we'll find that. So we know the algebra to calculate the S. So this 0.03 will not go with 90,000. Why? Because it has S next to it. Like in yes, let's see, suppose 2x plus 90,000 is equal to some 1,10,000. Assume this. Can I make 2x plus 90? Can I add this? It will be now 90,000 2x. No, it will be not. So anything with the x, it will not go. You can't add with this because it has a factor which you don't know. Okay. Now this will not, sorry, this will not go with this, but can this go with this, because x will go with x. So like this. So 0.03, if this come this side, what it will be? It will be minus. So now 0.06 minus 0.03 will be how much? Yes, the yes will be there. Now this side what is there? Only 90. Now 0.03 multiplied by s is equal to 90. Then if it is coming this side, multiplication, if it comes this side, it will become division. So it will be 90,000 divided by 0.03 is equal to yes. Then you will get what? You will get sales. So how much it is? 3 million. It is 3 million. Now under this sales, so what is this? This is indifferent point. If I do sales of 3 million, either I select variable cost, either I select fixed cost, my cost will be same. If you want to verify, we can verify. What is 6% of 3 million? One option is what? 3 sales 6%. 1,80,000. Next, second option is what? 3 millions 3%. How much it is? 90,000. And how much the salary we are giving? 90,000. So total how much? See, at the 3 million sales, I'm indifferent. Either I can choose this one, either I can choose this one. No problem in it. But now tell me, if my sales is more than 3 million, the company is predicting my sales will be more than 3 million. Which one you should select? Huh? Like you should select variable or fixed plus variable? Fixed plus variable. Why? Because whatever the sales will go, I'll paying them little bit only. Why? Because I'll be paying them how much? Only a small amount, because the fixed portion is there. Example. One example is, so suppose we did 4 million of sales. How much we did? We did 4 million. Now we'll go with two options. If it is more than 3 million, right? I'm telling you should select fixed plus variable. So what is 3% plus 90,000 will be giving? So what is 3% of 4 million? 1,20,000 plus 90. Then how much it is? 2,10,000. This is what I told, because this is what we have to do. Or if you are going fully variable, how much we have to give? 6%, which is 2,40,000. Now tell me, which one is better? Fixed plus variable, because that costs less. If you is that indifferent point, if you sell more than that, go with fixed plus variable. But if from that indifferent point, if you are selling lesser than 3 million, go with only variable. Why? Because you don't need to pay them fixed amount. You just pay 6% and leave it. Okay, clear with this? So this is an option between two cost option. Now we can choose between two productions option also. Okay, what is this choosing between two production option is? First we have to understand this. First we have to understand the profit formula. Profit is equal to what? Sales minus variable cost minus fixed cost. Okay, now we'll break again. Sales minus variable cost. Sales price minus variable cost per unit. What you will get? Contribution margin per unit. Contribution margin multiplied by number of units sold. Again you get same contribution minus fixed cost profit. Or you can also write like this. Revenue into contribution margin minus fixed cost. Okay. This one is fine. Revenue into contribution margin is what? Contribution margin minus fixed cost is profit. Now the last one says product says contribution margin ratio into revenue minus A's fixed cost. It should be product B's. Now we are selecting what? Between two production option. I mean, whether I have to sell this, I have to sell this. I have to choose this, I have to choose this. So, and we'll understand this with a option. So we have a thread mill A and thread mill B. We are selling these two products. This data is given, but the fixed cost of thread mill A is how much? 450. Fixed cost of thread mill B is 300. And yeah, income tax rate is 21. We'll leave that. Now we want to understand, if I sell what, if I make a revenue of how much, my both the cost, both the side I'll be same. Since both the thread mill need to have a same sales revenue. Okay, so for both the thread mill, so now what we'll do, we'll understand that what is a revenue point where both, either if I choose thread mill A or thread mill B, my profit will be same. So for that, what we'll take one for profit formula. Revenue into contribution margin ratio minus fixed cost is equal to profit. Correct? Correct? Huh? Okay. Now we know that we don't know the revenue. How much revenue if I make? Both are same, right? So I don't know what? I don't know the revenue. So we'll keep R here only. But we know contribution margin ratio. What is the contribution margin ratio of A? Calculate. 1040 divided by 1600. 60. And what about this? 0.6. Correct? Okay. So this is for A, okay? Now we are doing for A. So 0.65 is the contribution margin, multiply by R, but I don't know the R, but we know the fixed cost. Fixed cost is how much? 450 is equal to profit. Now for the product B, I mean thread mill B, contribution margin was 0.6, R minus 3 lakh is equal to profit. Now what we don't know in both? Revenue. At what revenue both will be equal? Now if I sell this or this, my revenue will be equal. We'll do that same we did in the last question, right? Now equal, write both the side. 0.65 R minus 450 is equal to 0.6 R minus 3 lakh. How much revenue if I make, but both the profit will be same? How to do this? Again, this R will go with this R and this 4,50,000 will go with 3 lakh, because we know this, right? The R will go with R and number will go with number. So if this R is in the plus, this is plus. If it comes this side, what will happen? Minus. So 0.65 minus 0.6 is equal to 450 is in minus. If that side it will go, it is in plus. But before 3 lakh it is minus. So again we have to do minus only. Minus if it is go, that side is plus, and plus into minus, again minus. So 450 minus 3 lakh. Now we know 0.05 multiplied by R is equal to 150. Then if this come this side, you have to do division. So 150 divided by 0.05 is equal to your R. How much it is? 3 million. So if you make a 3 million of revenue, either you sell this or sell, you will be indifferent. Okay. Clear with this? Again, this is also same, using fixed versus variable, two cost option. The one we did for the first one, right? Again, it's same. Now, the last point is product mix under constraint. Guys, this is important. Most students will lose marks. Complicated questions might come where product mix decision under constraint. To make it simple, I'll go with an example. So my revenue per unit is 40. Variable cost is 30. Then contribution margin will be 10. This is one product. Revenue will be 80. Variable cost 60. But contribution margin is 20. Okay. But to make this one product, to produce one product, I'm taking 2 hours. I'm taking how many hours? 2 hours. To make this one product, I'm taking 6 hours. How many hours? 6 hours I'm taking. Okay. Now, by seeing the contribution margin, which one is better? Product A or product B? Product B is better. Correct. But when you have a limited resource, assume that your machine hours is limited. Then which one you will produce? A or B? A. Why A? Because it is giving only $10, right? But it is giving in 2 hours. Then what you have to do is, you have to convert that into per hour how much they will earn. That is what under constraint we have to check. So you told it is A, correct? It might be A, but we have to prove it. So we have to convert the contribution margin into contribution margin per constraint. Here what is the constraint? Here the constraint is hour. So we have to convert the contribution margin into contribution margin per hour. So if I can make $10 from one unit, to make this unit I'm taking 2 hours. Then in 1 hour how much I can make? $5. Now we'll see the second one. I can make $20, but in how many hours? 6 hours. Then how much it is? 3.333. So hourly, who is making better? Product A is better. So we can go with product A, because under the constraint product A is doing better. It might be not only for hours, it might be in kilos. We have limited number of some chemicals, or we have limited number of some raw materials. We can produce A or B. So whatever is providing more contribution margin under the constraint will produce that one. When there is a constraint, okay? So that is called as working under the constraint. Now we'll see this. Contribution margin is how much? 250. Contribution margin is how much here? 300. If you look at like that only, I'll make A and B. B is making better. But machine hours per unit. But to make this, I'm taking 2 hours. Which one? A I'm taking 2 hours. But B I'm taking 4 hours. So to make it, to understand it better, we'll convert this into contribution margin per hour. So I'm making $250, right? Within how many hours I'm making? 2 hours. Then per hour I'm making 125. I'm making $300, but it takes 4 hours. So in per hour I'm making only $75. So what you can do? You can sell product A, which makes $125. Okay. This is per hour cases. If it is like this, okay. Sometimes they will give contribution margin of A, we can take 10, contribution margin of B we can take 20. Okay. I'm not telling how many hours to make. In 1 hour I can make 4 units, but in 1 hour I can make, okay, in 1 hour I can make 8 units. In 1 hour I can make okay, I can make like 4 units. So in that case, you can't go and divide it, because it is not like you're taking 8 hours to make. You're making in 1 hour, you're making how many units? 8 units. So 1 unit is giving how much? $10. So in 1 hour, how much you are making? $80. In 1 unit, how much it gives? $20. So you can make again 80. Okay. So, or I'll make it 50. So it can tell like I can make $100. Here I have did multiplication, but there I did division. Why? Because logically, if you think, it works like that. Because there I am taking, to make one product I'm taking 2 hours, but here I'm not telling that. In 1 hour I'm taking, in 1 hour how much product I'm making? 8 products, which means if I want to make it like in terms of minutes, like I have to convert into minutes, correct? So in I have to like divide by 8, then you have to do like, then you have to take that number, then divide 8. So understand logically where you have to divide, where you have to multiply. Clear? So that's it with the product mix under constraint. Clear? Okay. So we covered the CVP, cost volume profit analysis. So CVP analysis easier. So nothing complicated. What and all we covered in the CVP analysis. See, CVP analysis entire topic, right? It's interconnected. Nothing like new thing it's coming. First we started with one simple break-even formula. We keep on playing with that break-even formula, adding the profit, adjusting the contribution margin. Then we did the sales mix. Then we understand the indifferent point. The formula is same. Sales minus variable cost is equal to contribution margin. Contribution minus fixed cost is equal to profit. So if this understanding you have, CVP analysis is sorted. And the last contribution like this constraint contribution margin. So focus that, do more questions in Hawk. You have more questions in the contribution margin. Okay, in terms of constraint. Clear? Okay, done with your break even and CVP. Okay, we'll start with marginal. We'll do some theory before we start with marginal make or buy decision. We'll cover this theory and then we'll go for a break. Okay, so marginal analysis means what? So marginal analysis and its relevant information is a topic. Here we are going to discuss about what option to choose, where I can make more money, where I can make more profit, whether I have to start the business, whether I have to stop the business, whether I have to buy from outsider, whether I have to construct in-house, whether I have to take this order or not, and whether I have to process further this product and sell more in a high quality product or not. See, your normal one product you have, you can add some feature and sell for higher price. Whether you should do this or you should not do this, and how much units you have to produce to make the maximum profit. Because when you produce more number of units also, right, you have to sell it. When you want to sell that much units, ultimately the law of demand says whenever you want to sell more, what you have to do? You have to reduce the prices. Correct? And whenever you want to reduce the whenever you want to reduce the prices, what happens? It gives lesser profit. So that and all we need to consider. So this marginal, a rational business person will take any action if marginal benefit is more than the marginal cost. Marginal benefit means what? Extra benefit than the, if I'm getting extra benefit than the extra cost, I will go and do this. One example, if I want to tell, I was selling 1000 units. I want to sell 100 units. 100 units I want to sell extra. But to do this, I want to reduce my selling price. and whenever I will sell, I will incur extra cost also. So we have to go and check whether selling extra is making you profit or not. Okay. You completely ignore what you have already spent, sunk cost. That 1000 units will be there, right? That is already spent. Only we need to worry about this 100 extra. Okay, example, we see this example. You're going to purchase a cloth and they're giving 10% discount and 1 lakh. If you purchase more than 1 lakh, you will get how much discount? 10%. But if you purchase more than 2 lakh, you will get 14% discount. And you have already purchased for 1 lakh 90. So how much you will get discount? 14 or 10? You will get only 10, which is 19,000. You will get discount and you have to pay how much? 171. Now, if you purchase for more 10,000, you will reach the 2 lakh. Then how much you can get? 14%. If you purchase for more 10,000, you can get 14%. So you can get discount of 28,000. You will get discount of 28,000. Now how much you are getting discount? 19. If you purchase for more 10,000, you will get discount of 28. 19 minus 28, you will get extra 9,000 discount. If you purchase for 10,000. If I purchase for 10,000, I'll get for extra discount how much? I'll get 9,000. Now what is this marginal is? What is the extra benefit I'm getting here? No, benefit I'm getting. If I purchase 10,000 clothes, I'm getting a benefit of 10,000. But what I have to spend now? Just 1,000. If I spend just 1,000, it's enough. Because 171 I have to spend, right? Now I have to spend just 172 to get the $10,000 worth of clothes. Okay. So the marginal cost of the additional 10,000 in items added in order would be only $1,000. So marginal cost is how much? $1,000. Marginal benefit is how much? $10,000. Okay. This is how the marginal benefit and marginal cost plays. Now what is this marginal revenue? The extra cash you bring in from selling the one additional unit. If I sell one extra unit, how much cash I can make? What is the formula? Revenue after making the extra unit and revenue before making the extra unit. And what is the marginal cost? To sell that one extra unit, you will incur one extra cost, right? That is marginal cost. Okay. And what will be marginal profit? Marginal revenue minus marginal cost is equal to marginal profit. Clear? Okay. No, some information is not relevant. Why the some information is not relevant means, suppose if you already bought some machinery, then it is sunk cost. Example, you already spent on something. You already spent on car. You purchased the car already. Now you are thinking to go by car or to go by train. Okay. Will you worry about the car price now? You already purchased. Now what you will worry now? You will just worry about the fuel price. If you are traveling in a car, what is the fuel price you will incur? And if you are going in a train, what is the fare it will come? But the money you have already spent on the car, will you get back? If you are not traveling in a, if you are traveling in a train, no. That the money you spent on the car is right, that is sunk cost, which is not relevant in your decision making. Now you have a car, you want to go in a train, you're sitting and planning whether you will anywhere you write how car price 50 lakhs or 10 lakhs in the travel I will incur. No, you will not. You just write, okay, what is the price of the fuel I will incur? What is the toll cost I will incur? And if I'm traveling this much, what is the maintenance I will incur? This one you will calculate. And this side in a train, what is the cab fare it will incur? What is the train ticket price it will incur? This is what you will write. You will never write car price anywhere when you're taking a decision among the train and the car travel. Because the car amount It's already spent. So same way, in the company, whenever you take a decision, if it is already spent, if it is already done, that is called as what cost? Sunk cost, which is not relevant in your decision making. Okay. Now the company want to produce some phone, and they are spending $10,000 in the rent. You produce phone, or you produce tablet, you produce laptop, the landlord will not worry about it. He want what? He want $10,000 of rent. So the $10,000 of rent is not a relevant. Why? Either you do this, either you do this. The cost is same. See, when you need to worry is when there is a difference in the cost. Both the side, if it is the same cost, why you need to worry? Either I do this, either I do this, my cost is same. So then you don't need to worry about that. That cost is not relevant at all in your decision making. So now we'll understand what is relevant revenue and relevant cost means. If I do this and if I do this, if my revenue is changing, then that is relevant revenue. Only relevant revenue and relevant cost is considered in decision making. And differential and incremental. Differential means you have an option between two alternatives. Either you have to choose this, either you have to choose this. Example, you have an option to buy a petrol car, you have the option to buy a EV car. Now you are checking the cost. What is the initial cost? What is the yearly cost you will incur? That is differential revenue and cost. Incremental means you already have a car or something. You just want to modify it. You just want to build some, or you want to give that car and you have to bring some new car. There you are choosing between two options means you don't have a car at all. You have only these two options. Here you already have a car. It is not necessary you should need to buy a car. Then what you'll do? Like if you want to upgrade it, yes, you want to upgrade it, we want to upgrade it. So we'll understand what is the incremental cost we'll incur in the incremental revenue and cost. Now what is sunk cost? Sunk cost I already explained. The cost which you have already spent. Example, the 50,000 you paid for the software last year, it is gone. Do not factor into today's decision. That is not relevant in your today's decision. This is whole marginal analysis depends upon these two terms called as avoidable and unavoidable. The cost which you can avoid, is it relevant or not? Relevant. Why? If I'm not doing this, I can avoid this. If I'm doing this, I can't avoid. If I'm doing this, I have to pay. Correct. Example, if you are taking CMA course or if you're not taking CMA course. If you're taking CMA course, you have to pay for the membership fee, exam fee. If you're not taking, you can avoid. Correct. So that is there. That option is there, right? That is called as avoidable cost. And you are staying in a PG or you're staying in a place. So which is unavoidable? You have to stay somewhere. Okay, in life you have to stay somewhere. You have to pay the rent. Okay, or you have to eat the food, which is unavoidable. Either you take CMA, either you don't take CMA. You have to eat daily, which is unavoidable. Okay, so avoidable means there are few decisions. If you take that, you have to pay for it. But if you're not taking that, you don't need to pay for it. As in a company also, they are already into a landlord, they are already into a non-cancelable lease. So non-cancelable lease means even if you close the shop, also you have to pay them a rent. Now while you're planning to close this business, you need to consider all the things except rent. Why? Because you close the shop or you run the shop, you have to pay him the rent. Correct. So that information is not relevant. The one which is unavoidable is not relevant. So if I want to make it simple, avoidable is what? Relevant. Unavoidable is what? Irrelevant. In your answer, it is irrelevant. So avoidable cost or cost that can be avoided if a particular option is selected. Now example, you have a ACCA and a CMA course. If you are selecting ACCA, will you pay for CMA? No, right? So the CMA course you avoided. And if you're selecting ACCA, you can avoid the CMA. And if you're selecting CMA, you can avoid for the ACCA. So either this or that. Okay, now you want to do one course at a time. So you will not pay for both and go and write the ACCA exam. because if you select one particular option, you can avoid the other one. Okay, so avoidable costs are relevant to the decision making because they will continue one course of action but they will not continue if a different course of action is selected. If I select different one, this will not continue. Okay, so this is how we will take a decision in our life also. Whenever we come across a situation like this, what we will do? Okay, what if I'm doing this? What if I'm doing this? What if I want to go in train? What if I want to go in like a car or a flight? Okay, see, what if I want to like conduct some function very grand here? So how much it will cost? I want to make it simple. How much it will cost? So this one you will sit and analyze, then you will take a decision. Oh, this is how, this is how. Same way in the business also. So if you decide to outsource the production, example, your company is manufacturing smartphone, which iPhone they will manufacture, right? They outsource their display to Samsung. Correct. The display of the iPhone is manufactured by Samsung. Suppose if they outsource, do Apple need to keep a supervisor for a display manufacturing? No, it is not required. Why? Because they are not manufacturing. That is manufactured by Samsung. They outsourced it. So the hourly wage you pay for the display manufacturing, the supervisor cost, everything you can avoid it. Why? Because you gave the manufacturing of display to some other company. Example, if you manufacture a car, the tire, most of the car company tires, they buy the tires. So why? Because they are not manufacturing in-house. If they don't manufacture in-house, they no need to pay the salary for tire manufacturing. They no need to pay for the raw materials, rubber raw materials. So because completely they are purchasing from outsiders. And unavoidable means regardless of any action you take, this will be there. Correct? So future costs that you are legally or such structurally forced to pay regardless of option you choose. Clear? Regardless, either you manufacture display, either you don't manufacture the display. CEO, you have to pay him a salary. Factory, there will be a depreciation. Factory, there will be a rent. That is unavoidable. Clear? Avoidable and unavoidable. Okay. And there is explicit and implicit cost. Just today morning we discussed in the section A. Like explicit means paying a rent, buying a raw materials, paying employees. The money you pay is explicit. Implicit cost means, sorry, like this is implicit cost means the opportunity cost. Suppose my company had a two option to produce this, and okay, we'll do like this. My company had an option to outsource the manufacturing of display. Suppose if I outsource, the space will be free. So in this space, I can earn a rent of $50,000. Earn a rent of $50,000. So suppose if I manufacture in-house, will I get the $50,000? No, because the space I have used. So the $50,000 also need to be added while you're taking the decision. So this 50,000 is relevant. Why it is relevant? Because if you select the other option, you can get 50,000. Because you selected this option, you're not getting 50,000. See, in the option wise, your cash fluctuation happened. You went outside, you will get 50. If you want to manufacture, you will not get 50. So in the cost of manufacturing, right, you should add this 50 also. Why? Because that is the opportunity cost. Okay. Now these are the 4 topics we are going to discuss. We'll come after a break and we'll discuss this 4 different topic in the marginal analysis. What are the 4 topics we have? Make or buy decision, special order, seller process further, disinvestment. Make or buy means either you produce product in-house or give to the outsider, or take some special order from the customer, whether you have to take a special order or not. If you are taking special order, what is the minimum price you have to give? Sell or process further. Either I have to sell the product as it is, or I want to make some polishing and do something and process further and sell for the higher price. Okay. 4th one, disinvestment. My company is having many business. Do I need to close this business or not? Do I need to shut down this business or discontinue this business or not? This and all is a decision whether we are taking. Okay. Fine. This is a marginal analysis measure. This also will cover. We covered all these three. Marginal revenue means extra money you make by selling one product, extra cost you will incur by selling that one product, and this is the difference between marginal revenue minus marginal cost. So you can produce until your marginal revenue is equal to marginal cost. If your marginal cost is more than the marginal revenue, what you have to do? You should stop the production. You should not sell more. Why? Because more you sell, more you lose. Then these three things we'll learn. What is marginal product, marginal resource cost, marginal revenue cost. So after a break, we'll start with make or buy decision. Okay. Fine, we'll take a break and come back and we'll start with this topic. Start with make or buy decision. The first one in your marginal analysis. So make or buy decision means nothing but just either you want to buy the product from the outsider, raw materials, or might be some spare parts. Either you want to buy from outsider or you want to make it in-house. Okay. Now, if you see logically, when will a person will buy from outside rather than making? When it is less, when it is cost effective, we'll go and buy. If it is not cost effective, we'll make it. Okay. So to understand what is cost effective, what is not cost effective, we should understand what unavoidable cost. What is avoidable cost and what is not avoidable cost here. Okay. Suppose if I buy from outside, I can avoid all the raw materials, I can avoid the labors, and I can avoid some fixed cost also. Like supervisor salary is a fixed cost. See here, the matter is not fixed cost or variable cost. Here the matter is avoidable cost and unavoidable cost. So avoidable cost means avoidable variable cost and avoidable fixed cost. And the second thing we should understand is what is the purchase price of the item we are buying. Third thing, opportunity cost. Suppose if I buy from outside, I have a space, right? I can use this space and produce some other product and I can make profit. So that is the opportunity cost. Or I can give this space to someone else for a rent and earn some rental income. Opportunity cost. Suppose if I make here, I can't do this. So these and all is a opportunity cost. Now purchase cost means all these things will come. Purchase price, ordering cost, carrying cost, everything will be there. And only avoidable fixed and variable cost in our production are compared to cost of buying. With what you will compare? Avoidable fixed and variable cost with the cost of purchase. The buying price will come. These and all is irrelevant. What it is? Unavoidable fixed cost is irrelevant. Suppose there is some factory rent and all is there, which is non-cancelable lease, means it's irrelevant. Sunk cost, selling price is not relevant. Now we are selling price, whatever you sell, either you make it or either you buy it. The selling price doesn't have an impact because sales is that here we are playing with the cost, not with the selling price. Okay. Now in the make or buy, what is the maximum price we are ready to pay is, this is a formula. Okay, what is the maximum price we are ready to pay is all avoidable cost plus opportunity cost. All avoidable cost including opportunity cost is the price we are ready to pay. Correct. If I can avoid all this thing, if someone is giving me, I can pay to him. And any opportunity cost is there that we can add. And this is the maximum amount we are ready to pay. Here in this formula, they have given what? They have given all the production cost minus unavoidable fixed cost and variable cost. They took all and deducted what? Unavoidable things. But rather than I'm taking all, what I'll do, I'll take only avoidable cost plus opportunity cost. Suppose to manufacture the display, I'm incurring material, labor, everything is like $30. Plus in that space, I can produce something else and I can make a profit of some amount, which is $5 per unit. So $30 plus $5, a maximum I'm ready to pay how much? $35 for that product, not more than that. So the formula is like this: total cost plus opportunity cost minus unavoidable cost. Or I can take down this formula also: avoidable plus opportunity is equal to maximum price to pay, not more than that. If external price is more than the internal, in a bad deal. If outsider is giving costlier than us, means we should not take. Our operating income will go down. If external is lesser than the internal, means yeah, we can accept. Why? Because the outsider is giving for the lesser price. Okay. But there are other qualitative factors also we need to check. Only if we are buying from the outsider, right? So we need to consider these also: quality, reliability and delivery time, delivery terms, public relation and service. All these things need to be considered, because we are buying from outsider. The same quality should be there. If he is giving a cheap quality or not, he is not delivering on time and all, will not tolerate it. Because if he's not delivering on time, what is the use buying from him if you are not able to sell? Okay. So using this example, see, this company is producing the goalpost, and the total cost to produce one goalpost is how much? $650. But the outsider is offering for $490. If you are producing internally, what is the cost? $650. If you are going with an outsider, what is the cost? $490. So by seeing this, we can just say, oh, go with outsider and buy. But there will be some cost. If you go with outsider also, still will be there. If we go with outsider also, still the cost will be there. Those costs are irrelevant. Those costs are need to be minus. Correct? We learned one formula right now. Total cost minus unavoidable. Now we'll see what and all cost can be unavoidable. This they are telling this fixed cost will be there itself. This fixed cost will be there. So 650 is total cost minus unavoidable cost. This should be eliminated. This you no need to consider at all. Okay, next. And they're telling half of the selling and administration cost can eliminate. Half is avoidable and half is unavoidable. Then what is unavoidable? Half is unavoidable. Now check and say what is the maximum price to pay? 650 minus 175. How much it is? 447. So maximum we are ready to pay how much? 475. But for him, for how much he is offering to us? 490. So what we should do? We should accept? We should reject, because the maximum price we are okay to pay is how much? 475. But he is offering for 490. So we will not accept. We'll do internally. This is one way we can calculate. The other way is, okay, so if I buy from outside, how much I have to pay? 490. But will I still incur this 125? Yes, you will still incur. So add that. Plus half of this still will incur. Add this. So total how much? 490 plus 125 plus 50. 665. And if I'm producing internally, how much it is? 650. Either this way or that way, whatever. If you want, you can calculate. The best is what? Take the total cost minus all unavoidable, or take only avoidable cost. This, and half of this is avoidable. So you'll get same again 475 only. Okay. And here they are not discussing anything about opportunity cost. If there is any opportunity cost, you should need to consider that, and you should add in the maximum price to pay. Try this question. We'll do one question on make or buy decision and we'll understand this. Okay. So currently how much they are manufacturing? 30,007 for use. And what is the fixed cost here? 150. But we will be able to produce how much units? 60,000, but we are producing only how much? 30. If you are buying from the outsider, the facility would be idle and 40% of the fixed cost will be continuing. Now what you understand now from this? In fixed cost, they are telling what it will be continuing? 40% will be continuing. Then how much percent it will not continuing? 60%. So that 60% is what cost? Avoidable. Because if I buy, I can avoid the 60. 40 only will continue, right? 60 will not continue. If it is not continuing, it is called as avoidable. Okay. So we should understand. So what is avoidable cost here? 1,50,000. 60% is avoidable. Understood. There is no alternative use of facilities. If they are telling there is no alternative use of facility, means there is no opportunity cost. and variable cost of production is 111 and a fixed overhead is allocated based on fine. Now what is the maximum price you will be paying? First, if I buy from outsider, I no need to produce, so I can avoid this production cost, correct? Now 150,000 is what? Fixed cost. In this, how much percent can avoided? 60%. How much it is? 90,000. Okay, this is in total amount. Now we have to convert into per unit. So how many units we are planning to buy? So how much it is? 3 3s are 9. Okay, so maximum price we are ready to pay is how much? $14. Okay, so this is also avoidable, this is also avoidable. Suppose if I go and buy from the outsider, I can avoid this $11, which is we use for the manufacturing variable production cost, and I can also avoid fixed manufacturing cost, which is per unit $3 I can avoid. Okay, next, special order decision. What is the special order decision means? Sometimes we are doing a normal business, some customer will give orders, take this order, take this order, take this order, will give. In that case, whether we need to accept the project, whether we need to accept this order or not is a question. And what is the minimum price you have to charge? I'm not telling the price you have to charge. What is minimum you have to charge? You can charge more than that, but not below than this. If you are charging below than that, what is the consequences? You are making losses. So in this topic, we learn two things. What is the minimum price to charge? Whether should accept or not. Now in this, there is a two cases. What are the two cases? One, we have a bandwidth, we have a capacity to accept this. Then fine, you go and accept. If they are giving minimum price, if they are giving minimum price, accept. The second case is when you don't have a bandwidth, you don't have capacity to do, you are already in full. Then in that case, what you have to do, we'll understand. So here, whenever you charge a customer, what and all you charge? All the production cost you have to charge, because I'm manufacturing this watch, and to manufacturing this watch I'm incurring what and all I'll incur? Material, labor, overheads, material, labor and variable overheads are a manufacturing cost, and variable selling price, because if I want to pack this and to deliver this, there is a variable selling price. So this is a cost I'll incur to manufacture this. So this cost I need to charge. Minimum at least this much I should charge, right? Keeping a profit, not keeping a profit, other question. Because if I charge below than this, what is the use? I'm making losses. Or I'm charging exactly the same amount. Then it is indifferent. You can sit quietly. Why you have to do all this? So at least you have to charge $0.01 more than this. Minimum at least should be the cost of this watch. Okay, so then comes the capacity status. Capacity means what? You are running at full capacity or less capacity. Running at less capacity means what? You have a capacity to do. If you have a capacity to produce, if you have a capacity to accept the order, then only take avoidable cost of production. If I am accepting your order, what is the cost I will incur? If I am not accepting your order, what is the cost I can avoid? That cost only need to be considered and I can charge from you. This is a minimum. But if I am running at full capacity, I'm already, my customers are buying it, they are giving me profit. Can I accept this order? Yes, you can accept. When he has to pay me for my sacrifice. So if I want to accept his order, I sacrifice my regular sales, because I told my customer, I'm not selling you, I don't want your profit. So who should give this profit? The person who gave the order, who gave the special order. So now we have to charge the cost plus the sacrifice. Two things you have to pay now. Cost plus sacrifice. When we are at full capacity. So you should understand the question. when you are at full capacity, when you are at less than capacity. When you are at full capacity, what and all you have to pay? Avoidable cost plus lost contribution margin, the sacrifice I did. And if we have a capacity, then only direct fixed cost, like only the variable manufacturing cost is enough. Okay, now we'll understand this with this example. We are manufacturing two products, refrigerator and microwave, and what is the profit per unit? 125 and 75 we are earning. Okay, example 1, example 2. Example 1, we have a capacity and this guy is giving 200 refrigerator order. How much? 200 refrigerator. So what is a charge? What is a selling price you will keep? Minimum. Will you charge for the variable cost? Yes, because if I'm not producing for him, I will not incur this. So it is avoidable. So I'll charge from him. Will you charge fixed cost? No, because either I accept your order, either I'm not accepting your order, fixed cost will be there. So it is irrelevant in the decision making. So what I'll only charge what? Only the direct manufacturing cost, because fixed cost is not required. Fixed cost, why it is not required? Either I produce, either I don't produce, either I take your order, either I'm not taking your order. It is indifferent. It is indifferent. So only how much I will charge? I will charge only $100. This 0.01 is for what? A profit. At least I will charge that like that. This is when I have a capacity. Understood why I am not charging fixed cost? Because fixed cost will be there. Assume I am paying a rent in this place. I have a capacity. One new customer came and gave the special order. Now by accepting this order, will my rent change? No. If I'm not accepting the order, the rent will change? No. So it's not relevant. If I accept the order, the raw material will change? Yes, because I have to invest more raw material. If I accept the order, the labor will change? Yes, because I have to pay them hourly basis. I have to pay them. Which one will change? Only the variable manufacturing and selling cost will change, which is avoidable cost. Now we don't have a capacity. What we don't have? We don't have a capacity. But if you are accepting this order, we will be not able to produce 300 microwaves. We are producing both refrigerator and microwave. This guy is giving a 200 order. But if I'm taking this order, what I will not get? I will be not able to produce how many microwaves? 300 microwaves. If I'm not able to provide 300 microwaves, what I'm losing? Contribution margin of 300 microwaves I'm losing. Who should give that? That special order guy should give that. What is the contribution margin I'm losing? 300 into 125. How much it is? 37,500 I'm losing. So if I'm charging only 100, is it enough now? No. I have to charge 100 plus I have to charge 37,500. But 37,500 is a full amount, right? Now I will convert into per unit. How much I lost? For what? To produce how many fridge? Per fridge, how much I will charge to him? $187.5. So what and all I will charge? I will charge him for the variable cost plus I will charge him for the lost contribution. So I will charge how much? For the same fridge, now I will charge 287.5. Clear with this? Any doubts? Clear? So what and all? One variable cost. See, fixed cost nowhere in the picture. What and all I will charge? $100 for the variable cost plus 187.5 for the lost contribution margin, because this is in 37,500. That too for 300 microwave. Now it is 200 fridge, right? On each fridge, how much I will keep? 187, 187, 187. By that, if I'm keeping 187 on each fridge, if I'm multiplying with 200 fridge, I can get my 37,500 back. Clear with this? That's it. So try this question number 2. Should the company accept the order or not? The question is what? Should the company accept the order or not? What is the question? It will be like, he is offering some price. Is it enough? How many units is ready to purchase? Company regularly sell this for how much units? 95. But this guy is asking for how much? 80. Can I sell for him or not is a question. If he is giving minimum, what is the minimum? To understand the minimum, we should understand whether we have a capacity or not. First of all, when it is a special order decision, the first thing you should notice is what? Whether you have a capacity or not. Now we have a capacity. So if we have a capacity, if he is giving what is enough? If he is giving anything more than the avoidable cost is enough. Now material, can I be avoided? Yes. Labor, I can avoid. Variable overhead, I can avoid. Fixed overhead, no, I can't avoid. So fixed overhead is not into the picture. Only these three things is enough. So how much is the total variable manufacturing cost is coming? How much total?
75.5 plus additional shipping cost.
Where is additional shipping cost is also there? $4.
Including 79.
Okay, fine. Because the shipping cost is what? Only not manufacturing cost. I told all the variable cost. This, if I'm not accepting this, I will not ship. Because of accepting this, this cost came. So I should add this $4 also. So I'll add this 4. So total how much? So my variable cost is 79.5. What is my selling price is giving? 80. So what we told, anything more than the avoidable cost is acceptable. So what is the contribution margin we can earn here? 0.5, because 80 is more than 79.5. So we can clear cut, we can accept the order. So it says yes. But now the question is how much it will increase. Will it increase by 750 or will it increase by 6,750? So how many units is asking from us? And on each unit how much he will give? So how much we can earn? Clear? Contribution margin into units. Okay. Now this question. What is the question? The minimum amount we need to charge. Again, it's the same type of question. They are telling what? What is the minimum amount I have to charge from him? That is a question. No. First of all, I told you, before we answering this type of question, what you have to understand, whether we have a capacity or not. In this question, so we don't have the capacity. No capacity is there. If you don't have the capacity, what is the minimum charge? Avoidable cost plus opportunity cost. So first we'll go and see what is avoidable cost. Material, labor, variable manufacturing overhead, variable selling. These are the avoidable costs, right? So to calculate this, what is avoidable cost? Can you tell? 137. Any other cost is there? Nothing, right? So 137, correct? Plus opportunity cost also need to be considered. No, they have only given, suppose if I accept this order, I will lose how much? I will lose 15. In the microwave and fridge, we went and understood what is the contribution margin we lose. In this question they given. How much we lose? 15. No. By accepting how many orders I am losing this? By accepting 500 orders. Now this 15,000 need to be distributed among this 500 units. So on each unit how much it is? 30. D is your answer. What and all we have added? Variable cost plus opportunity cost. Clear? Okay. Next, the third one is sell or process further. What is the sell or process further? Means suppose if you are doing a joint manufacturing, in one manufacturing process you will get multiple products. And when you can identify the each product individually, it's called as a split off point. Example, suppose my company is providing my company is manufacturing petroleum, like we are into the crude oil business. So when we do a crude oil refinery is done, because crude oil you can't use directly into the vehicles, so you'll do refining. So in the refining process you got 3 different products. What and all you will get might be like, you might get petrol, example, okay, diesel and kerosene, like this multiple products you will get in the same process. So this point is called as what? Split off point. But to manufacture these 3 things, I had incurred only one cost, is called as joint cost. Now to process this further or not, do I need to consider the joint cost? No, joint cost is irrelevant because you already came till here. Now you want to go further or not, whatever you spent earlier will be not impacting. You already reached to a place. Now you want to travel to a different direction, whether I want to go further or not. No, do you even consider what is the cost you spent? No, you just consider what is a cost I will incur in the future and what is the benefit I will incur in the future. Example, suppose in the joint process I spent 10,000. I got 3 products, product A, product B, product C. Product A, after joint process at the split off point, means at this point if I sell like that only, I will earn $25. This I will earn 35. This I will earn 45. At the split off like this I will sell. Now if I want to process further, I mean to add something, polishing, to add some chemicals, add some features and everything. After adding all this feature, I can sell for 35. This I can sell for 45. This I can sell for 55. You can sell more, but to process further, it will not come free. You had a petroleum, you want to make a premium petroleum, so you have to add something. So in that you incurred $8. Here you incurred $12. Here you incurred $9 to process further. Now you are sitting and considering whether to process this or not. Whether to process this or not. Does this joint cost of 10,000 is relevant? No, it is not relevant, because now your question is what? Whether to sell as it is now or whether to process further. Correct? Now tell me, will you process this further? What is the in this, what 2 things you should understand: incremental revenue and incremental cost. Extra revenue, extra cost. What is extra you can earn? Extra you can earn $10, but extra you have to spend 8. So now tell me, will you process this or not? You will process. Why? Because you can earn $2 extra. Now we'll come to this. Extra, how much you will earn? Again 10. But extra cost is how much? 12. But here if you process further, you are losing $2 on each unit. So this one you have to sell as it is. Sell now. Once you got a joint cost, you can sell now. Don't process it. Next, third one. What is the extra you can earn? 10. What is the extra cost you will incur? 9. So what is the profit you can make? 1. So this one you can process further. That's it with this. So this is called as sell or process further. Whatever you spent right already, that is sunk cost. Only you have to compare with extra revenue with extra cost. Okay, clear with this? Okay. Now we'll go through this example and tell me whether you need to process it further or not. Say, suppose they are doing something. You just have to understand whether it is increasing my operating income or decreasing my operating income. Okay, what is the question? Okay. A circuit board company conducts a joint manufacturing process and they are producing 10,000 units of board A and 10,000 units of board B. So top, how much? A 10, B 10. The total joint variable manufacturing cost to produce this two product is 2 million. Now tell me, is this relevant or not? No, it is not relevant. Why? Either it is variable, either it is fixed. It is joint cost, not relevant. Now we'll go next. The company can sell 10,000 of board B at split off point at 300. B I can sell now for how much? 300. Or process further and I can sell this for how much? 375. Okay. The total additional cost to process further is 5 lakh. How much is additional cost I will incur? 5 lakh. And all additional cost will be variable. If the company decide to process product B, what will happen to the operating income? See, forget about A, they are just asking about the B. Now, do you need to process further or not? If I am processing further, will it increase or decrease my income? Now tell me, will you process it further or not? So simple thing, they have given the total processing cost, but all the things are given in per unit. Either you convert all the things into total or you convert that 5 lakh into per unit. So how many product B are there? 10,000. Then per unit is how much? 50, right? So the extra cost you will incur how much? 50. Extra how much you can earn? How much extra you can earn? 75. But extra how much you will incur? What is your answer now? You will process. By processing, you can earn or you can lose. Earn. So which means it will increase. So the B I have scratched out because it says decrease. How much extra you can earn? Okay. You can earn on each unit. How much you can earn? 25 extra. How many units are there? 10,000 units are there. Correct. So how much you will earn extra? 2,50,000. C is your answer. Simple as that. See, this type of question they will give. One they will give in per unit, one they will give in total. Convert the per unit into total or total into per unit. See, if you would have converted 3 lakh and 300 into 10,000, you will get how much? 3 million. Okay. Same this side also. Either you can do this or that, no problem. Fine. So extra 250 you can earn. Okay. So what you will do? You will process it further. Now try this one. Which one you will process further and which one you will sell at the split off. Try everyone. And answer your question. Yes, try. Everyone. Online, offline. What you will do? Which one you will keep and which one you should keep outside? See, two things is required. Joint cost and everything you can forget. This joint cost and all is not required. So what and all is required? Extra cost, extra earnings. No.
We'll avoid C.
Huh?
We'll avoid C.
We avoid C. Okay, why you should avoid C? Because at the split off, because at the split off you can sell at 3. Here extra how much you are earning? 0.75. But extra how much is the cost? 0.9. So the cost is more than the benefit. So how much you will lose? 0.15 you will lose. So you can avoid the C. What about B? B you can do. Because B and A you can do. So the answer will be what? Product C you have to spell it split off, and A and B you can do additional processing. So answer is A. Clear? Now next is disinvestment. What does this disinvestment means? So in the disinvestment decision, we have to understand these steps. First, identify all unavoidable fixed cost. What you have to identify? Unavoidable fixed cost. Identify all unavoidable variable cost. First thing what you have to identify? Anything which is unavoidable, you have to identify. Then identify all avoidable costs that will be incurred if the decision continues. And you have to identify what? Avoidable things. Okay. What does this topic says? I have like 3 to 4 division I have. I want to close one of the division or I want to close one of the product. So in this case, if I close this division or if I close this product or division, will this is it profitable or is it making more loss? We have to understand. Okay. So to make this, we'll start with an example. As a company, I have 2 divisions. Division A, Division B. In Division A, I am earning 250,000. Division B, I am earning 350,000. And variable cost is 1 lakh. Here the variable cost is 150. Then what will be the contribution margin? 150 here. Next, see, if I'm closing this division, there were few managers. Okay, there are few managers which we can fire them, like which we can remove from the work. Then we no need to pay them a salary. If I close this division, so what? It is a fixed cost. Salary is a fixed cost. But if I close this division, I can avoid this. Correct. If I'm closing the division A, I can avoid this. Example, like suppose my company is selling both products, car and bike. Suppose if I want to discontinue the bike manufacturing. So if I discontinue the bike manufacturing, this one what I can do? Like, and I can send everyone home, like I no need to invest on their salaries. So what I can do? I can avoid the fixed cost. What cost this? Fixed cost, but it is avoidable. What is avoidable fixed cost? Example, the avoidable fixed cost is 1 lakh. Here the avoidable fixed cost is 1,20,000. Okay, clear? Then what will be the next segment margin I can get? Here how much I can get? 50. Here how much I can get? 80. But there are few fixed costs which is allocated. Example, my company was having headquarters. This car and bike manufacturer is having a headquarter. There will be a headquarter rent. As example, the headquarter rent is like consider it is 1 lakh. Headquarter rent is 1 lakh. Now this headquarter rent, who should pay? Headquarter rent is not making any money. These 2 division, car division and bike division, should contribute. Okay. If I close any of the division, will the headquarter rent will change? No, because that headquarter will be there. Either you close this division, either division, the headquarter rent will be there. But now this, I told how much is the rent? So 60,000 is allocated to A and 40,000 is allocated to B. We are just allocating it. So 60,000 allocated to A, 40,000 is allocating to B. So here what will be the loss? 10,000. Here how much will be the profit? 40,000. Now by seeing this, what is the company A is doing? So division A. Division A, we are having a loss. So now the company is planning to close this division. So after closing this division, is it profitable or not? Because this is a loss making division. If I close this division, is it profitable or not? Is it profitable? No, but this is making loss, right? But it should be profitable, because if 10,000 if I lose, if this making losses, as a whole company, what is my profit now? 30, correct? As a company as a whole, what is my profit? 30, because here I am making 40,000, but here I am losing 10,000. So ultimately, what is my profit? 30. So now tell me whether closing a will increase my profit or decrease my profit. Decrease the profit. But closing a I can keep my 40 now with me only, right? Why I should bear 10,000 loss? What is the reason I should continue division A?
Even if we close division A, 1 lakh rent has to be paid.
Yes. So now what happened? The allocated fixed cost. What cost? The unavoidable. Because those are unavoidable. Now the unavoidable fixed cost from 60,000 from this side, it will go completely this side. So then what will happen? This division will make, as a company whole, they will make 20,000 loss. Because of the division A, they are able to cover what? This allocated fixed cost. So that is the reason. What is the step? Identify all avoidable and unavoidable cost. Anything which is unavoidable, it is not relevant. So you should stop till here only. While taking the decision, you will stop till here. So this is called as segment margin. This is called as segment margin. How much they are contributing to the company? Because as they own, they are contributing this much. See, this 1 lakh and this 120 I can't avoid. Sorry, I can avoid. So if I'm closing A, still I can ignore that. But if I'm closing B, I can still ignore 120. So this is called as what? Segment margin. If your segment margin is in positive, if your segment margin is positive, you can run the division. If segment margin is negative, you should stop running the division. But here, this is segment. This is as a division margin. Okay. So this is called as segment margin. What is the formula for segment margin? All segment revenue plus all avoidable cost is equal to segment margin. Here you should stop. If your segment margin is positive, you keep the division. Okay. Clear with this? Understood? Any doubts? Yes, any doubts on this? Okay, here you see both the segments are giving positive margin. So we can go and continue the business. We'll start with 2 questions, I think, from this. Yeah, try this. If the company drops this cookbook division, the square footage used will return to the landlord. Dropped cookbook will cause the company's operating profit too. Suppose if I drop this, my operating profit will be increased or decreased. You have to tell. Check. Now, first for this, okay, I can avoid this, correct? I can avoid the cost of goods sold. Order and delivery processing, can avoid. Rent, okay. But rent they are telling separately. Here if you see your line, what does it say? Read this. Return to the landlord. Suppose if I close this business, I can return the place to the landlord. Then do I need to pay the rent again? No. So you can avoid or you can't avoid? You can avoid. Yes. So this is also need to be considered. It is not that if you see rent, it is not avoidable. They will give some notes telling that, see, this rent you can avoid. See, the question is not fixed cost or variable cost. As I'm telling you, repeating you again, the question is about avoidable or not avoidable. Next, it is what? Allocated corporate cost. Allocated corporate cost means, example I told, right? As a corporate, as a company, they have some cost that they are allocating to us. Suppose if you are running this business or if you are not running this business, still you will incur this 7,000. So first we have to go and find now what? Segment margin. check whether your segment margin is positive or not. Here, till here is your segment margin. So 24 minus 18 minus 2. How much? 24 minus 18, it's 6. 6 minus 2, 4. So your segment margin is in positive. If you tell me if the segment margin is positive, what we have to do? Continue. If you are not continuing and if you want to close, what will happen to your, if you are closing, assume that you are going to close. What will happen? Will it increase your income or will it decrease your income? It will decrease your income. So either this 3 option. Now if I close that A, this cookbook, I was earning 4,000 as a segment margin. Now I will be not able to earn. If I'm not able to earn, it will decrease in my company's profit. So what is your answer? B is your answer. Clear? So if you understand that segment margin is enough, revenue minus all avoidable cost is equal to segment margin. If segment margin positive, run. If the segment margin negative, stop. Try this.
Okay.
I'll zoom this option, you can check later. So now they are planning to close this unit. See, as a operating income, it is loss. Correct. Now, if they are closing it, first we have to go and check what? Their segment margin. So, variable cost is there. Direct fixed cost means the cost which is related to this. Suppose if I close this particular product, right, I can avoid that 3 lakh. So allocated fixed cost, if you see the word allocated, means it is unavoidable. So it is allocated. It is a corporate cost which is allocated. Like example, rent. The rent, company's headquarter rent is allocating to this. Suppose if I'm running this, if I'm producing this product, or if I'm not producing this product, still it will incur. From here it will jump here. That's all. That will not make any difference. So this is not required. So now from here we'll put a stop and we'll calculate what? Segment margin. Go and check the segment margin. Correct? 50? Not 50. 750 minus 400. 350. Okay. 350 minus 300. Sorry. It is 50,000 is in positive. So now what you have to do? They are telling you should run. Like you should close. So if you close, it will increase your income or decrease your income? It will decrease. So where and all it is telling increase, scratch it. And what is the option? Decrease by 50,000. Because I am earning 50 from here. If I close, I will not earn. If I am not earning, that 50,000 will get reduced from my company. Okay. Clear with this? Clear with the 4 options we studied? What and all? Make or buy. Okay. Disinvestment. Special order. Sell or further process. Clear? Okay. Now at last in the marginal, this marginal costing, we have this. I told, right, we should understand these terms. We'll understand these terms. You know already marginal revenue is. What is marginal revenue? The extra revenue you will earn by selling one extra unit. Marginal cost, the extra cost you are incurring to produce this extra unit. Marginal profit is nothing but marginal revenue minus marginal cost. Okay. Now these are the 3 things, which is marginal product, marginal resource cost, marginal revenue product. Marginal product means additional output. What it is not telling 1 and it is not in dollars. This is only one, it is odd. Odd means everything is in dollars. This only one is in the units. Additional output by putting 1 input. Example, I appointed 1 labor. He is producing 10 new smartphones. 1 input is what? Labor. What is the additional output? 10 new smartphones. 10 smartphones, 1 labor. Clear with this? What is marginal product? Marginal product means marginal physical product. How much physical product he produced? 10. By using how many input? 1. By using 1 input, how many outputs I can get is known as marginal product. Marginal resource cost means to bring this 1 input, I would have incurred some cost. That is marginal resource cost. That guy, whoever came, is producing 10, right? We have to pay him salary. That is called as what? Marginal resource cost. Marginal revenue product is nothing but marginal product is there, right? Marginal product into selling price is equal to marginal resource product. See, he is producing how many units? 10 units. Each phone I am able to sell for $100. So 1000 is what? Marginal resource revenue product. Now, if your marginal revenue product is more than marginal resource cost, you appoint him, because this should be more than this. If the resource cost is more than revenue product, you should not do that. So clear with this? Okay. Now in this table, what you have to understand is you should produce, guys, this will again come in the pricing strategy when we are discussing about the different market. You should produce a product until you are reaching where? MR is equal to MC. Marginal revenue is equal to marginal cost. Why? If your marginal cost is more than marginal revenue, you are not making money, you are losing money. We'll understand with this table. We all know that if you want to sell more, what you have to do? You have to reduce the price. See, price is going down. Same time, when you produce more, at some point the cost will go down. Why the cost will go down? Because fixed cost per unit will go down. 10,000 I'm paying rent. If I'm selling only 1 coffee cup, means per coffee cup 10,000 is a rent. If I'm able to sell 10,000 coffee cup, means per coffee cup now how much is the rent? Only $1. So fixed cost per unit will go down. So what happened? The cost per unit is also going down at some point, but then it will increase. Next, total revenue, what will happen? Yeah, it will keep on increasing only. See, because sell more, you will earn more. That's it. But marginal revenue, what is happening? It is like it's keep on decreasing. But marginal cost is also what is happening. It's keep on decreasing. See, cost is also decreasing, revenue, marginal revenue. Why marginal revenue is decreasing is when you are selling next product, what you are doing this side? Selling prices keep on reducing. Example, we'll understand now. One into 480. How much is the revenue? 480. Marginal revenue? 480. Now, if I want to sell 2 product, my selling price would be 460. So I will make how much? 920. Marginal revenue means what? If I want to sell 1 extra, I want extra, how much I will earn? How much extra you earned? 440. Next, you will earn 1320. How much extra you earned? If you compare 1320 minus 920 is how much? 400. Again, you will get this. The difference between these two is 360. Again, multiply this two, you will get 2000. The difference between these two is 320. Like this it will happen. Now we'll come to cost. Multiply this, you will get total cost. And the difference between the cost is called as marginal cost. Okay. Now we'll focus on the revenue. Marginal revenue. What is happening to the marginal revenue? Keep on decreasing, because you are reducing the selling price. Marginal cost, what is happening? It decreased. See here, 852 and 210, 200 till here, and next you are seeing it is 220, 320. Again, what happened? A jerk decrease. Then again, a spike in increase. So it will be in U shape. It will be in U shape. First, what will happen? The cost will fall from here. Then it will again increase. So this is how the marginal cost. Why the marginal cost is increasing is because whenever you produce more, correct, you will incur the extra additional cost of fixed cost. Your fixed cost need to be, because once you are going outside the relevant range, what happened? extra rent you have to pay. See, in this room, I can sell 5 units. If you want to sell 6th unit, I have to get another room. So I have to pay the rent for that also. Now per unit, if you see, the cost is high. Because of that, marginal cost will increase. But you should stop where? 5th unit you should stop. Why? Because MR, how much? 320 is equal to MC. And going forward, how much is the profit you made here? 200. Then you see the profit is declining. So you should stop at this point. Guys, you should stop at the point where you reach MR is equal to MC. Don't try to sell more than that. Don't try to produce more than that. So this is very important to understand the pricing concept. So where you will stop your production? MR is equal to MC. Okay. That's it. And using this also we can understand what it is. Marginal product and marginal resource cost and marginal revenue product. You should stop appointing the extra person when you reach marginal resource cost is equal to marginal revenue product. Why? Because you have one machine and you are appointing 2%. Fine, it will work well. One machine, 20 members. What will happen? Now each member will produce lesser units because the machine is not free. If each member is producing lesser units, the output is less. If the output is less, the marginal revenue product will be less. But the cost is increasing. We have to pay them the same salary. But the output is going down. Revenue product is depend upon output. So it should stop where? When MRC is equal to MRP. Clear? That's it with the marginal costing. Okay. We will take a 5 minutes break, then we'll start this demand, supply and pricing. We'll try to cover as much as we can in the demand, supply and pricing, and then we'll leave for the day. We'll take 5 minutes break. We'll come back at 3:05. So third topic in your section C, we covered marginal analysis and CVP. The third topic is demand, supply and pricing. Okay. So the customer, the factor that supply and demands is known in 3 C's. One is customer demand, competitor price and cost. What is this customer demand means? What is the customer is valuing you as a product? What is the value they perceive as a product is known as customer demand. What is the price they are willing to pay is called as demand. We'll tell that, right? This product demand is only this. Okay. And competitor price is also involved. Suppose the product demand, everyone is telling, okay, 100 is the product demand. $100 we can sell, but the competitor is selling for $30. Now can you sell for 100? The customer is perceiving the value 100. Oh, we were selling 100. The competitor came and is selling for 30. Now can you sell for 100? No, everyone will go to the competitor only. Third thing is a cost. Suppose if the cost is higher than the demand or the value the customer is perceiving, you will not produce it. Example, the cost is $100, but the customer is asking this product for $80. Will you manufacture and sell it to him? No, because it is incurring as a loss. So these are the 3 things which will impact. Now we all know that demand means like a law of demand. A law of demand states what? A price of a product is inversely or negatively related to demand of the product. Higher the price, lower the demand. Correct? So you see this example, when the price was $6, we were able to sell 300 units. But when the price was just $2, we were able to sell 600 units. So lower the price, the demand is increasing. Clear? So if you put in the graph, this is quantity demand and this is price. Just understand the graph also. Okay, sometimes they might give a graph and ask you to answer the question. Where is what it is linking. So when the price was $6, I was able to sell only how much? 200 units. But when the price was $2, I was able to sell 600 units. Okay. Now for all the product, it is not same. We have something called as elasticity of demand. Elasticity of the demand means how the demand responds to the price. Some products will respond very aggressively. Some products will not even respond. Some products will respond very little. Example, medicines or daily need product like electricity, water. Medicine and all will not even respond. Whatever the price, we have to pay it and we have to buy it. Okay. And water and electricity, yes, we can, at least the demand will go down. We will not waste the water, we'll be very mindful. We will not waste the electricity, we'll be very mindful. Example, like when the electricity price is higher, what you'll do, you'll not turn on the fan on every room, on every light. You'll be very mindful and you will turn off. When the price is cheap, what you'll do? We'll put everywhere fan, lights, everything. You'll roam full home, and mom or dad will come. Is your current bill is paying your dad or what? They'll ask. Correct. She will ask the same. Yes, obviously dad is only paying, but still this is a very relevant question. What I get in my home. Okay. So that's how it is. Like, it is not that you will not use the electricity. You will use, but it will be mindful. So that depends upon the elasticity of the demand. Okay. So where the elastic and inelastic, it depends upon if the demand, if a 1% change in price, if a change of price 1%, but the demand is changing more than 1%, the demand is responding very aggressively, means that is called as elastic. If I change 1% in the price, demand is changing more than 1%. It is responding aggressively. So it is elastic. So in this case, what you have to do, decrease the price. If you decrease the price, what will happen? You can sell more number of units. So you can earn more. Now inelastic means the 1% change in price is not causing that much change in demand. The demand is changing lesser than 1%. Okay. So in this case, what you have to do? Increase the price. However, the demand is not changing, right? You will be able to manage to sell the same number of units or little bit lesser. But if you increase the price, what happen? You still earn more. Example as electricity or water. Water is inelastic or the electricity is inelastic. When the price increase, the unit price will tell. In the electricity bill, you can see the unit. By unit, they will charge this much rupees. If you increase the unit price, what will happen? You will use the electricity. It is not like you will not use the electricity. You will still use the electricity, but you will be consuming less. Might be in the factories. Example, LPG now. Correct. So LPG now increased. The price is increased. But it doesn't mean you are not using the LPG. Okay. So they increase the price. But yeah, now we are, many people are cooking in the induction or some other method. But still the demand is still there. It is not like, oh, the demand went. So still the increase in price will cause the demand little bit lesser. So this is a curve for elastic and this is a curve for inelastic. So the curve for elastic will be like this. See, I changed, what is the price I changed? I changed from 4 to 5. My demand went from 600 to 400. Just we'll compare the percentages, you see. We'll understand we changed from 4 to 5. We increased the price. How much we increased? $1. From where we increased? From 4. How much percentage we increased the price? 25%. What happened to my demand? My demand decreased to 400. How much demand decreased? 200. From where it came? 600. What is the demand decreased? 33%. See, I increased my price by 25, but my demand got increased more than that. So the demand is responding aggressively to the price. But in this case, you see, I increased how much? Same, 25%. But my demand 50 reduced from 450. How much it will be? 450 divided by, 50 divided by 450. 12 or something. 11, right? 11%. You see, I increased my price by 25, but my demand got reduced just 11%. Okay, this is inelastic. And perfectly price elasticity means customer have infinite choices, so your demand drop to 0. Example, you're just increasing $1. Your demand is going to 0. When it will happen? When everyone is selling the same product with no differentiation. In that area, you have like the place where your home is there. If everyone is selling the same groceries, like example, everyone is selling a tomato for 30 rupees per kilo, but one guy is selling for 32. Will anyone will go and buy? Everyone is near. So what you'll do? Why have to pay $2? Quality, no differentiation, nothing. Nothing is different. Will you pay 2 rupees extra? No, because it's exact same product. Why you have to pay extra? So his demand will come to 0. No one is going to purchase. So that is called as perfect price elasticity. In the perfect price elasticity, the company or the person who's selling, right, he don't have a choice. He have to accept the market price. He is not a price maker. He's a price taker. He just, what is there? It's acceptance. Like a perfect price elasticity, the daily product is there, right? Daily usage product, like a rice, not differentiation. That and all is perfect price elasticity. Okay. Not perfect price inelasticity means opposite. No matter whatever you do, the demand will not change. In this case, the demand is changing into 0. Here the demand is not even changing. Example, medicine. Whatever the price increase or decrease, the demand will not change. Price decrease happened. Will you eat 2 tablets? No, right? We'll still eat, consume 1. Oh, price decrease, oh, we'll consume more. No. And sometimes like price increase means will you not eat the tablet if you have a fever or if you're diagnosing with something, you still go and buy. So the curve is, see, here the demand will drop to 0. Where? If you increase, the demand will drop to 0. But here, whatever is the price, whatever my price, my demand is still same. My demand is still stays same. This is perfectly inelastic. Okay. Now, how to calculate the perfectly elastic and perfectly elastic? One I already showed you in that graph only. I showed you. The other one is midpoint method. So first we'll do percentage method. See, the formula is easy again. Percentage change in demand divided by percentage change in price. If it is more than 1, elastic. If it is lesser than 1, inelastic. Example. So I am changing my price from 4 to 5. My demand drops from 120 to 80. So what is the numerator? Percentage change in demand. Demand will be in the numerator. How much my demand decreased? 40. From where it is decreased? 120. How much percentage it got changed? 0.33. Okay. Now percentage change in demand divided by percentage change in price. What is the price changed? $1. From where? $4. So it is 25%. Now we'll put in the formula 0.33 divided by 0.25. What is it? 0.32. If it is more than 1, it's elastic. Okay. And the problem with this percentage method is, now you go from 4 to 5 you did, right? Now you go from 4 to 5, like 5 to 4. My price is increasing from 5 to 4. My demand will increase from 80 to 120. But it will give a different number. That is the problem with the percentage method. But it will give the correct place, whether it is elastic, whether it is inelastic, that doesn't make a difference. That point it gives correct. Percentage method will tell, oh, this is elastic, this is inelastic. But the problem with the percentage method is this one. Same numbers. But if you are going in the opposite way, it gives a different value. But still it is elastic. Both are elastic only. But to solve this problem, we have what method? Midpoint method. In the midpoint method, this is a formula. What is it? Q2 minus Q1 divided by Q2 plus Q1 divided by 2, which is nothing but quantity average. If I want to break this, demand difference between the demand divided by average demand divided by, again, like this is a division, different between the price divided by average price. That's it. You see, Q2 minus Q1 is what? Difference between the two demands, and plus divided by 2 is what? Beginning plus ending divided by 2 is what? Average. So that one you have to use. Now we'll use the same formula. First one is what? Numerator should be what? Demand. Denominator should be price. So first what we'll understand? First we'll understand the difference. What is the difference? No, we'll only go with the numerator, then we'll play with the denominator. What is the numerator? Difference between the demand, 40, divided by average demand. What is the average of this? 100. Numerator is sorted. What is your numerator then? 40 divided by 100, 0.4. Okay. This is about the demand is solved. Now we'll come to price. What is the difference between the price? 1. Divided by average price is how much? 9, right? 9 divided by 2, 4.5. Now what will be your denominator? 0.222. Okay. Now you have numerator. Now you have denominator. Now put everything. 0.4 divided by 0.222. 1.8. So this is, again, it says elastic. But if you go ulta also, you will get the same 1.8. See, here also 1.8, here also 1.8. Why? Because it takes average, it takes difference. If you take a different like this also, it is a different. If you take average anyway, it is also average. So this midpoint method will, either way you go, it gives the same value. But percentage method, it will give the answer, whether elastic or inelastic, but it gives a different value. Okay. So this is the answer. If you are getting as a 0 means it's perfectly inelastic, which example I told of a medicine, right, which doesn't change. If you are getting lesser than 1, what it is? Inelastic. If it is equal to 1, unitary elastic. Whatever like price change, the demand will also change the same percentage. Price 1% change, demand 1% change. Price 10% change, demand 10%, which is equal to 1. Numerator is also 10, denominator is also 10. If it is more than 1, which it is elastic, relatively elastic. If it is undefined, which means I told the demand will go to 0, like the numerator will be 0 here. 0 divided by anything is undefined only. So it is undefined. So the demand is going to 0. Clear with this? Okay. Now price elasticity and total revenue. If total revenue is equal to what? Price into quantity. These both are only we are discussing now. If that this is a shortcut to understand, if the demand is elastic, what you have to do? You have to reduce the price, you can sell more. So your total revenue, oh sorry, what happened? Like if the, okay, total revenue decrease. I mean, if you increase the price, right? Suppose if you increase the price, if demand is elastic, revenue will go down. In that case, what you have to do? You have to reduce the price. If it is inelastic, your revenue will increase. If it is equal to 1, it will not change. But same, it will happen in the opposite. So we have a table here which will help you to understand. So if the demand is elastic, what you have to do? Increase the price. Price increase, total revenue will decrease. And if it is inelastic, and the price decrease will increase. If the demand is elastic, what you have to do? Like, no, you have to decrease the price, so you can sell more. So what you have to do? Your total revenue will increase when the demand is elastic. So demand elastic, decrease. Demand inelastic, increase. Unitary elastic, nothing will change. Okay. Okay, now we'll come to the supply point of view. Demand is inversely related to price, but supply will move on the same direction. Price increase, supply increase. Suppose you are running, so you are doing some manufacturing product. When you want to sell more? Whenever the price is more. Correct. Whenever market price is high, so we'll sell more. Correct. That is what we want. But when the market price is low, we'll sell little bit. So if the price goes up, quantity goes up. If a price go down, quantity go down. Okay. So this will be the curve. Opposite of demand curve. See, when the price increased from 2 to 6, quantity supply is went from 200 to 600. Okay. But the problem is, supplier want price increase, customer want price decrease. So they have to reach at one point to agree that, yeah, I'm okay to sell at this price, I'm okay to buy at this price. That is called as market equilibrium. Okay. So suppose if the price is set high, if the price is high, what the supplier will do? Supplier will produce more. If he's produced more, what happened? He filled with a warehouse with lot of goods now. Lot of goods. So now, when the customer will buy that? Whenever you reduce the price, he will buy. Excess demand. When the price is too low, will the supplier will give the product? When the price is too low, will you produce the product? No. So then what it will create? It will create the demand. When it will create a demand, usually in the market, when there is a demand, what happened to the price? Price will increase. Whenever there is a supply, what happened to the price? Price will decrease. So the one thing with this lot of supply will have a lesser value. We all know that. Whenever the supplier have produced n number of goods, when the price is high, you will be able to not produce, you will be not able to sell. Then what the supplier will do? Supplier will reduce. Whenever the price is too low, the supplier is not ready to sell. So then what happened? When there is a problem with the supply, we know that in the market, whenever there is no product, the demand of the product will reach high. So the price will go up. So supplier will bring down, customer will bring up, they will reach at a point. That point is called as equilibrium point. This is an exact X where the two curves intersect. At the specific price, the customer want to buy at exactly equal to the what is the producer want to sell. So this is a quantity. So the price of 400, supplier is ready to produce 400 units. So, and the customer is ready to buy at this price. Okay. So this curve, supply curve, demand curve, market equilibrium curve, these three curves is very important, because next we are going to learn with the market conditions. So it will be too tricky. So understand these three curves. It's very important. So at the price of 4, everyone is ready to buy and sell this. Clear? Okay. Pricing by market structure, we'll do it on Monday. Okay. We'll continue this revision on Monday, but before coming Monday, please understand these three curves, where it will sit, and understand MR is equal to MC, because next topic whatever we are going to discuss, it discuss about MR is equal to MC, it discuss about the total cost, it discuss about the demand, it discuss about the supply, it discuss about the market equilibrium, and discuss about the profit. Okay, because we are now we learned as a whole market, but for every product the market is not same. Some product is monopoly, some product is oligopoly, some product is perfect competition, and some product are monopolistic competition. Okay, so we have the 4 different market, 4 different curves we are going to learn. Okay, so before this, base is important. So we clear that base and we'll come back and we'll start with market pricing by market structure. So yesterday and today we covered section A, and section C is half of covered. So go through this, go through the textbook, and go through the videos if required. Try doing more questions. You might be having the materials, right? Try doing more questions, because right now you're done with the revision. If you try right now, it will strike it in your mind. Okay guys, thank you.